I'm still very bullish on the overall AI infrastructure.
Second quarter earnings will probably mark the peak.
That bar, again, has become so much more challenging for rewards here.
There are legitimate questions about cash flow.
Aren't we all believing a little bit too much into that U.S. exceptional picture?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, ready for the weekend. The U.S. equity market heading for back-to-back weekly losses as the White House is threatening bigger and broader strikes on Iran. President Trump is rebuilding the tariff war with new levies on 60 economies.
Between 10 and 12.5%, that is the new levies under Section 301. This was widely expected as a way to get that income back that you hadn't gotten. I wonder if this is in response at all to the bond yields. I know this is kind of a crazy conspiracy theory, but there is this thought that people are getting increasingly concerned about deficits because you are not getting the income from what we had expected from tariffs. So if you recreate them in one way or another, maybe that could bring in revenues. Either way, it seems like people are wanting to fade the story hard as they have to focus at least on oil.
I'm sure the Treasury Secretary loves the idea of more money coming to the United States, but Trump is tariff man, and the tariffs were always going to persist. He just had to find new ways of enacting them. One administration official, though, did reject the idea that Trump was imposing these just to purely replace the earlier duties. But it clearly looks like a plug and play for what happened with IEEPA, which was struck down by the Supreme Court.
We got some better news this morning, at least. Crude is pulling back. Bring up the board. Brent WTI down by 3 to 4% this morning. Brent pulling back from $100 a barrel to 96.88. Check out the bond board too. 2s, 10s and 30s. Yields coming off the highs of the year. And in some parts of this market worldwide, the highs of the last several years, and for that matter, the last several decades. The 2-year at the moment is about 432, 10s at about 468. Yields are elevated here. So we've had the energy shock. We've had the rate shake-up. We haven't had the growth scare. And I think that third dimension is really, really important. So when you look at this bond board, why are we holding these levels for longer? It's precisely for that reason. We haven't had the growth scare off the back of all of this.
This is unusual. Typically, when you have bond yields up, that is a problem for equities, yes, but typically there ends up being some sort of self-fulfilling prophecy where people go back into bonds. That's not happening precisely because of what you are saying. Yesterday, we had the lowest initial jobless claims going back to 1969. One earnings after another highlight the strong consumer. I keep going back to Capital One, the fact that their charge-offs came in so much lower than they had expected, that they delivered much better than expected results. There isn't a sense of pain. In fact, it's resilience and even growth for the U.S. consumer.
We don't have a problem in the labour market, not an obvious significant one anyway. So if you're going into the meeting next week, you can't really lean on that as a dove right now. As a hawk, you can just point to inflation, and inflation being a problem. This came from Guneet Dhingra of BNP Paribas. BNP Paribas and Guneet has done a fantastic job of calling out this bond market ahead of time. When he talked about 5% not being a ceiling for this bond market, I wrote to him yesterday, this is what he said. Sticky inflation, healthy growth, hawkish Fed, ever-rising deficits, Bremo, and AI build-out raising the cost of long-term capital. It is harder to see how yields stop rising.
And that's what you're seeing right now, not only in the U.S., not only in Europe, but also in Japan. And guess what? We heard this morning that the Bank of Japan isn't going to be hiking rates in response to this. And guess what? The long end of the Japanese yield curve continues to sell off. And so at a certain point, you have to wonder whether this is a resetting in global markets in a new era where suddenly we went from a financialized market where people could make money by actually just going into financial assets to one where people need to build stuff. And when you need to build stuff, it is a very different proposition in terms of the value of money and how much people demand to have the privilege of borrowing somebody's money.
You're just itching for the weekend, right?
No,
Seriously?
I could do this for another.
I thought we're not allowed to talk
straight.
about the weekend at 6 a.m.
No.
That's a 9 a.m. conversation
Honestly,
as long as I've been working with you.
I'm there right now. It's just been one of those weeks, right?
Friday.
Wow. Not that far. Friday is banned.
I know. That's why I'm going to keep saying
Without
it all
a doubt.
day.
We can talk about the weekend, but Friday is banned.
Okay.
Okay.
It's been a long week.
Yields this morning just about unchanged on 10. Small rally at the front end of the curve. The 30-year is not bouncing. Yields are unchanged there. 30s around 517. Coming up this hour, we'll catch up with Keith Lerner of Truist with stocks on track for back-to-back weekly declines. Angelo Zino of CFRA as Intel shatters expectations. And Rebecca Babin of CIBC with crude hovering near triple digits. We begin this hour with stocks attempting to rally following the biggest one-day drop in a month. Keith Lerner of Truist writing, the encouraging development is that this is still looking more like rotation than broad-based liquidation. Keith joins us now for more. Keith, I don't know when you wrote that, but does it apply to the price action of the last 24 hours too?
Oh, yeah, certainly. And hey, good Friday, Jonathan. Friday. Listen, even yesterday, we had that, some big cap tech names down a lot. And then you looked at the board yesterday, you had energy up, you had industrials up, you had financials up, you had healthcare up. So I think we're still seeing this big move up. But I also, if you zoom out a bit here, Jonathan, back when we had that rally off the lows in March for the S&P, there was only one sector that outperformed, one, and that was tech. And tech was up 47%. The closest sector behind it lagged it by almost by more than 20%. So you had expectations reset higher. It was one sector that's very dominated, and now that money is rotating to other areas. And to the point that you just discussed, it's not leaving the market; it's just rotating to other areas. And you're also having some pretty good numbers yesterday. If I looked at the board yesterday, you had a lot of these industrials, up 3, 4, 5%.
Keith, I think in some ways that speaks to what we're talking about in the bond market too. I mentioned these rolling shocks that we're experiencing right now through energy, through interest rates in the bond market. And I think it's important to point out we've had the energy shock, we've had the bond market jitters, we haven't had the growth scare. And Keith, does that speak to maybe your enthusiasm for this rotation in equities, which is a risk asset that should be sensitive to the growth backdrop? You believe that can continue?
Yeah, I do. I will also say at the same time, Jonathan, we're still positive on tech longer term. I just think, as I mentioned, that it got too far, went too far too fast, and now you're resetting. And as we've been discussing this morning, the economy continues to prove resilient. And in fact, I think, most on Wall Street, if you thought, maybe a month ago, if you said, hey, yields are at 470, where's the stock market? You probably would think it would be, hit a bit more. And you are seeing some of those tighter financial conditions hit in more of the growthy areas of the market. But all in all, I would trade a stronger economy than a weaker one with a little bit higher rates. And I think that's what the market's doing, because ultimately that should still feed into strong earnings, which continues to be the North Star of this bull market.
Which is the reason why, Keith, we're seeing a lot of people say the rotation is intact, but maybe the Magnificent Seven, or more specifically, the hyperscalers are no longer the same kind of bet that they were, say, 6 months ago. Yesterday, the biggest one-day decline going back to Liberation Day and some of the turmoil there in 2025, almost $800 billion in value erased from this particular index. Is it a buying opportunity or is it a warning shot?
Maybe somewhere in the middle. I mean, one of the dichotomies we wrote about, coming out of last month was that, the tech sector was up 18% at the time. At the same time, the Mag 7 was actually down for the year, and that's a lot because of semiconductors. So, I would say more broadly, not just the Mag 7. I mean, the one thing that kind of stood out to me is, late last year, the technology sector was trading for about a 32 multiple. Now that's down to about 23. The premium for tech to the overall market early in this bull market was about 45%. That was the peak. And now we're down to about 10. So at least the good news to me is you're resetting expectations. And even though, as not saying something specific about a recommendation for stocks, but Google and revenue and Intel's revenue numbers were 25%. It's hard pressed to find that. So overall, I still think ultimately that tech will be a buying opportunity. Is it right here, right now? I'm not sure about that yet, but ultimately, I think money will rotate back into tech. And the last thing I'll also say is we continue to have this love-hate relationship with tech. This is the fifth pullback of at least 10% during this bull market. During the entire bull market, tech has doubled the S&P 500. So it's just, like I said, the love-hate relationship that we're seeing.
It does feel a little bit different this time. And I know I'm going to get pilloried for saying that because those are the most hated words in financial markets. There is a new cost to borrow money for some of these hyperscalers in particular. And I wanted to bifurcate the tech universe into the hyperscalers, the spenders, and then the receivers, as John does a good job of talking about the wealth transfer. At this point, it does seem like the charge is getting bigger for a lot of these hyperscalers. Their desires are continuing to grow at paces that we cannot track. And there has been a sense of concern in markets at a time of already elevated bond yields around the world. Doesn't this change the calculus on some level, on a multiple level, or even just on a growth prospect level?
Yeah, certainly. And I would say, Lisa, one thing we've been really starting to track even more closely is breaking out all the technology, big cap tech stocks and look at credit spreads. And they're moving up. And even like Oracle being the poster child, you're seeing when CDX makes a new high, the stock is moving lower. So, I think it is very important. I think it is one of the key risks that we're looking at. But I guess as I think about things is, we were trading at a 32 multiple. Now we're down to a 23. That premium that I mentioned has really evaporated. So at least in my mind, the market has re-rated down because of those very risks that you're talking about. So I guess the open question is it re-rated enough? And again, on a very short term, I think it's a difficult call. But I think at this point, at least we've really reset expectations. Again, not recommendations on individual stocks, because that's not my area of focus. But even like you look at, after what happened with Alphabet, you're trading at a sub PE relative to the overall market as far as a discount now. And at the same time, you're seeing these companies with really strong revenue growth. So I think all that's in the mix, Lisa. But I think, again, I would still think I'm giving tech longer term the benefit of the doubt.
Yesterday was different, and Bramo, I'm pleased you went there. Yesterday was different because this equity market punished the spending of Alphabet and Tesla and didn't reward the chip makers, which is where the money would go. Semis were down on the session yesterday, which I think would be surprising for a lot of people if they looked at the numbers of the spend coming out of the likes of Alphabet and the likes of Tesla. So you have to question the effectiveness of the spend, return on investment, and the durability, the sustainability of the spend as well. And the cost of capital is going to become increasingly important. I think you can see that in bonds and increasingly, just on the margin, just a little bit more. You can see it in credit too.
Yeah, right now you're starting to see spreads widen, as Keith was just talking about. And yesterday we saw some real pushback. But you're right. Normally the wealth transfer would be alive and well, and you'd see that inverse relationship. The idea that it's not indicates that maybe people don't believe that spend project can really continue at the pace that it is, or that there's going to be enough competitive pressure to lower prices, lower margins, and potentially get some new competitors into the field.
I'm not going to draw firm conclusions from 24 hours of price action. Lisa won't either. But Keith, it's notable that yesterday chips didn't rally. That had a nice little run going into earnings. Monday, Tuesday, decent few days of gains. 3 days, I believe, on the semis, Keith. Then things started to change just yesterday. What was your reaction to that?
Well, I mean, I think it is important. It's like, as you mentioned, right now, there's so much uncertainty about how all the AI spending turns into cash flow, and when. But I also remind folks, semiconductors just came off an 80% plus quarter. So in some ways, I think that was anticipating these good numbers, and it's priced in. So it does tell you at this point that this kind of cooling or this reset in tech and semiconductors likely has a bit further to go because it was so overheated. In fact, the move that we have seen in semiconductors over the last year is the strongest we have seen since the late 90s. But ultimately, I think one of the things that's different so far, and we can debate this, is valuations are half of what they were in the semiconductors back in the late 90s, and earning trends are much stronger. Obviously, we are still asking the question of what's normalized earnings as well. But I think the main point, going back to where I started, is you had a lot of good news priced into this quarter. So I'm not surprised you're not seeing the reaction, because you were up 80% for the overall index.
Keith, it's good to see you, buddy. As always, Keith Lerner there of Truist on this market. If you're just tuning in, welcome to this program. No doubt the first thing you looked at was maybe crude. This morning we're pulling back by a little more than 3%. Brent down to 97. We had a little look at triple digits in the last 24 hours, a pullback of 3% so far this morning. The words of the president in the last 24 hours, according to Axios. The president telling Axios on Thursday he's seriously considering restarting major combat operations in Iran. Yet to be seen what that looks like heading into the weekend.
Yet to be seen what that looks like, but at the same time, we have heard from CENTCOM, and last night there was another round of attacks, 13 straight days of attacks. The president also said in that interview that they haven't received enough pain yet, talking about the Iranians. He clearly wants the regime to capitulate, and at this moment they're not. And when it comes to the Red Sea, some vessels are still starting to turn around, while others are going for it and trying to get through the Bab el-Mandeb Strait.
We'll have more on that story a little bit later this hour. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. The U.S. will impose tariffs of between 10% and 12.5% on imports from most major trading partners, after finding about 60 economies harmed American workers by failing to prevent forced labor. It's the biggest move yet by the Trump administration to reconstruct the tariffs that were struck down by the Supreme Court. The Magnificent Seven suffering their biggest one-day drop since the tariff sell-off last April. The group losing almost $800 billion in market value, fueling the sell-off disappointing earnings from Alphabet and from Tesla. Intel shares, though, rising in the pre-market. The chipmaker's revenue forecast shattering Wall Street estimates. Intel reporting its fastest revenue growth in 15 years and adding $2 billion to its capital spending plans as demand for chips used in AI data centers accelerates Intel's turnaround. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Everyone's going to say Friday on this program now,
100%. And I am so here for it. I can't wait to see.
You like that word?
I love it. I use it every day.
Can't stand it.
Oh, I know. I actually have no real strong feelings, but I think it'll be really fun.
What did Kobe Bryant say? It's not over. right?
It's not over. And actually,
Week's not over.
And actually, today could be a really telling cap to
It's
a
not done.
tumultuous
We have
week.
2 hours and
done.
45 minutes left.
We have a lot more than that.
You sound like you're there already. You really do. Up next on the programme, threatening further escalation.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. They would like to do something, but I say they're not ready yet. We want to get it over with, and we want to do it right.
2 hours, 45 minutes sounds like torture for Annmarie. You're going to be OK.
Well, what are the stories we're talking about? Conflict, tariffs. That's my world right now. I know you guys are in some AI bubble, but...
We'll get to your world in a moment, OK? We'll make sure those 2 hours and 45 minutes fly by. Up next, Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. The price of oil, setting the tone for the price of everything. We're pulling back by 3% on Brent this morning, around 98. As Annmarie pointed out yesterday, 2 choke points now, not one. A much smaller cushion of inventories, a move of 15% plus last week, up around 10% so far this week, pulling back 3 so far this morning. Under surveillance this morning, threatening further escalation.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. They would like to do something, but I say they're not ready yet. We want to get it over with, and we want to do it right. We have to do what we came to do, and that's we can't let these people, they're very violent people, we can't let them have what they want.
So here's the latest this morning. The president threatening to escalate military strikes on Iran. Axios reporting the president is, quote, close to making a decision on attacks surpassing Operation Epic Fury. Bloomberg's Tyler Kendall has the latest this morning. Good morning, Tyler.
Hey, John, good morning. Well, as the White House weighs this wider escalation, the U.S. is dealing with this whole new front. And President Trump's threats are now extending beyond action taken by Iran in the Strait of Hormuz and to action taken by the Iranian-backed proxy group, the Houthis, in the Red Sea, as that maritime blockade creates another choke point. And we're starting to see data analyzed by Bloomberg News show that Western ship owners appear to be making alternate routes and travel plans to avoid that Red Sea path, while those countries with closer ties to Iran, like China, have seen their ships transit safely. In a new post last night on Truth Social, President Trump threatened, quote, major military punishment for targeting any commercial shipping and said damage done to cargo or vessels would be paid for via Iranian assets the U.S. controls. He didn't elaborate on how this would work, whether or not the U.S. would pay shipping companies directly, but we have to keep in mind the context here that this is the same exact money that had just been on the table as a potential economic incentive for Iran to agree to curbs on its nuclear program. But, John, at this point, we've gotten very little public indication that diplomacy is getting back on track. As you guys have discussed, yesterday, CENTCOM confirmed the 13th consecutive day of strikes, and we've seen Iran continue to target U.S. assets and energy infrastructure in the region.
Tyler Kendall with the latest. Tyler, thank you. Appreciate it. To build on that story, Colonel Wayne Sanders of Bloomberg Intelligence joins us now for more. Colonel, welcome to the programme. We have a new front, a new choke point, and in many ways it's an old choke point, an old front, an old problem. We have experience dealing with the Red Sea. Can you describe our experience in the last several years, how difficult it was to counter the disruption caused by the Houthis and how difficult it might be this time around?
We had to spend quite a bit of assets actually helping out Saudi Arabia in that region, specifically not only from an air defense threat from the Houthis themselves, but also then offensive capability supporting Saudi Arabia in that region. To be able to take them and bring them down to a level where, from a military capability perspective, we would call that a degraded capability. And so the U.S. was involved in that with the Saudis, and it got to a point where we think it was almost ready state operations, if you will. And then obviously then when the Iran conflict came up, this is something that I've been keeping a close eye on because I was actually worried that this was going to be a pressure point that was going to be pressed by Iran and by the Houthis. And now you're starting to see that as part of Iran's strategy going forward right now as an additional lever against the U.S.
When the president says I'm considering a massive attack bigger than ever before, what does that mean in DOD speak? Are these different targets that the United States is looking for?
Yeah, I would say it's going to be both, not only different targets, because up until now, I think there's been certain ones that you would call almost like restricted targets because of how high the operational and strategic risk may be for hitting some of those targets. But due to the casualties, the U.S. service members who were killed in Jordan, I think this is one of those times where then you start to accept some additional operational risk. So you're going to see some, your standard IRGC Navy bases, missile production facilities, drone manufacturing, and all things air defense. But what you probably may see now is the IRGC command and control centers that may be closer to Tehran. You may see something against Natanz, Isfahan, and Fordo, and just creating a deeper crater in the ground during that area. Strategic energy production sites may be in there. And now, as we're sitting here talking about the Red Sea, long-range missile sites in Yemen could be another one of those pieces. Coastal forces at any time, anything that's going to try and help the Houthis in this blockade is going to be something that would be a target in that area.
I'm glad you brought up the casualties because the Pentagon had announced that a total of 18 American service members were killed in the war in Iran on Wednesday. Then on Thursday, that number dropped to 14. Why?
I apologize. I'm not tracking that. I was still tracking the number as 18. I don't know whether or not they're looking at it as they're changing the number in terms of maybe direct casualties due to a strike that took place from Iran, as opposed to, northern Iraq when it was a controlled detonation that killed one of the service members. But I'm speculating at that point.
Colonel, is this a winnable war? Is there any kind of paradigm where you could see some sort of successful or at least satisfying end to what we're seeing?
Yeah, that's a difficult one because I don't think there's anybody who ever wins in a war. I think the best way that you can look at this is this was a war that needed to be fought in terms of Iran's dominance in the Gulf region based off of their military capabilities. That's been a big thing that President Trump has really tried to push, not only the nuclear side, but also just from the ballistic missiles in defense. So a lot of those capabilities have come down. It's allowed some of the Gulf states right now, even when they start looking at harden some of their military capability. So I wouldn't call it a win, but I think that those would be some of the only silver lining in this conflict that you could really point to at the end is that the Gulf states, the GCC has come up and said, hey, we're not going to take any more of this, and they have strengthened their positions. Iran still wants to be able to say that, hey, we have the ability to affect Strait of Hormuz, but we're willing to not. I think it's a political side that Iran would be looking for to win, and the U.S. needs to be able to say that they did decimate Iran's military capability.
Colonel, what would it take for Gulf nations, Gulf allies, to take more of an offensive posture in this war?
That's a great question because when you look at it right now, UAE's already increased their air defense focus on commercial infrastructure. And you look at Bahrain, who's the most exposed because of Fifth Fleet headquarters. They've largely remained out of it as much as possible at this point in time. I think that when you start hitting more and more of the civilian infrastructure, UAE is a great example. Iran's gone after their economy. So they're trying to bring in, I think at this point in time, where they're really trying to get to is they have to have enough military capacity. Up until now, they focused on some defensive capability. If you start seeing indicators into long-range strike munitions being purchased by some of these Gulf states, that's when they're going to say that I now have a strategic deterrence option, and it's not just a defense against Iran.
Colonel, it's good to see you. I appreciate your input and your insight experience. Thank you, sir. Colonel Wayne Sanders there of Bloomberg Intelligence. It became the story that you wanted to ignore and could no longer ignore once crude popped into the 90s and breached triple digits on Brent just briefly. It was in all our faces. This morning, we're back down to about 98. AMH, WTI, 89.
Yeah, crude's going to be going higher, and potentially it depends. I mean, I know we're off the highs of yesterday, but we have to live with higher for longer, potentially throughout the rest of the summer if the president is preparing major strikes that are going to expand what's going on in the conflict. And then, of course, you introduce the Houthis, and that's a whole other problem.
I'm watching diesel up 10% since July 5th. This is an input into every other component of inflation. Now $5.24. Watch this space because that's going to reverse what we saw in the CPI and PPI.
Nothing Friday about crude product right now, right?
Well,
nothing good about this story.
There's nothing Friday about a lot of this, and that's the truth. You're trying to kill it right now?
It's dead. It's gone.
It's not.
It's banned.
It's going to keep coming up.
Up next, Intel running in the pre-market. Mag 7, 5% slide in yesterday's session. Bramo gave you the number, $800 billion of market cap, shaved off that particular group of stocks. This morning, a pretty unconvincing bounce, to be honest. Alphabet up by 0.75%, Microsoft up by 1%. It's mixed. Meta's down by 0.2%. In the equity market more broadly, on the Nasdaq, on the S&P 500, heading towards 2 weeks of losses for both the S&P and the Nasdaq 100. The first back-to-back weekly loss for the Nasdaq, I believe, the Nasdaq 100, since March. Futures up by a few tenths of 1%. On the S&P, a few tenths of 1%. On the Nasdaq, and not a convincing rally in the bond market either, given the sell-off we witnessed over the last several weeks. Twos hanging on to 432. 10s hanging on to about 470, and 30s still well north of 5%, and yields not coming in.
You know, there had been a lot of different stories that were kind of offsetting one another. Even though you had concerns about the Middle East, oil prices had come in enough to allow the AI story to take hold. Right now, that is not the case. Oil is clearly in the driver's seat, and a lot of these problems that get more magnified when borrowing costs go up are accentuated in the artificial intelligence trade. So yesterday was a puke day, and today isn't exactly a buy the dip day, because we don't know exactly when this is going to resolve or if it could potentially get a whole lot worse. Halima Croft talking about how this really is an incredibly dangerous tipping point with a lack of inventories and, frankly, not a clear off-ramp.
So let's stay on the market and let's use that word danger zone. People used to think that was 450 on 10s. It's not. 460? It's not. Is it 470? I don't know. But I don't think this is a market, an equity market, going through a growth scare right now. And that's the important distinction to make this morning. And I keep going back to the framework. The rolling shocks that we've had so far in the last 5 months. You've had it through energy. You've had it through fixed income. You have not had a growth scare off the back of that. That's the missing component of this, is why the equity market is still within 2.5 to 3% away from all-time highs.
It would take a bigger shock, and people say, how much bigger? Annmarie talks about, is it going to be $100 a barrel in terms of oil? And when you start talking about levels, what everybody on this show says, it's not just about the level, it's about the pace of increase. It's the pace of increase in oil, and it's the pace of increase in yields. Right now, the pace of increase is starting to get alarm bells to go off, even if this economy is less interest rate sensitive.
Brent crude, let's check out the price of oil this morning. Oil is down by 2.9%, but it's another big weekly rally, building on last week's big weekly rally. This morning, 98 on Brent. WTI just short of 90.
Since the skirmishes started again and the attacks around July 10th, we're up some 25-30% on the oil price. We thought after 4th of July, potentially we were going to see this downtrend. We were moving forward. More ships were getting to the Strait of Hormuz. Now the attacks continue, and we've already bled through all those inventories. And now we introduce another issue with another choke point, which potentially could be a massive problem for Saudi Arabia and the global market.
Crude down this morning by close to 3%. On our radar this morning, the president rebuilding his tariff agenda, imposing sweeping new levies on 60 U.S. trading partners. The White House turning to the Trade Act of 1974 to invoke the tariffs after the Supreme Court struck down his initial duties. Elsewhere, the president considering a massive attack on Iran as he aims to force the country to the negotiating table. Trump telling Axios that Iran hasn't yet received enough pain and the strikes would be bigger than ever before. And finally, Meta facing higher borrowing costs for a $12 billion deal to fund a data center in Texas. The Financial Times reporting investors are demanding a higher risk premium than its last financing deal as unease builds over AI exposure.
We've seen this movie before, right? I mean, this is Alphabet and what they experienced when they tried to raise money in a very similar transaction and faced a higher borrowing cost. This is a borrowing cost not exactly going to stop the presses at 0.4% percentage point higher than what they did earlier this year, but it highlights the exhaustion in debt markets right now of absorbing all of this debt. Just to put it into perspective, Amazon, Alphabet, Meta, Nvidia, and SpaceX have sold a combined $219 billion so far this year. Given the competition from everywhere else, given the endless rosters of wish lists that we are seeing from all of these companies, people are just feeling a little bit like they need more to lend their money.
The pushback started with the SpaceX debt. I think it built when Amazon followed. And you're right to point out we need more money. It's important to make that distinction. The market's still open, but at a price. And the market's pushed back and said, if you want to keep coming to market, there's going to be a price, a high yield that we need to be compensated with.
They're still willing to borrow. And frankly, people are still willing to lend. But at a certain point, you start wondering how much is this going to impede valuations at the very least. And you start to say, actually, what's happening in markets and the route that we saw yesterday makes a lot of sense. Because suddenly the valuations are not as high as they used to be if you're actually burning cash and borrowing money at a higher rate at a time when the component costs are increasing as well. So all of these things leading to that little bit of skepticism. Some people are saying this is a healthy skepticism. Other people are saying, let's see how far it goes.
It's always a healthy shakeout.
It's a healthy
when you're bullish, right? It's always a healthy shakeout. It's a healthy rotation.
Yeah, but no one's saying it's a buying opportunity. Whenever we ask, is it a buying opportunity? Well, it will be.
On the bond side of things.
On the bond side of things, you've seen all of these bonds sell off since they were sold, all of the AI-related debt. You start wondering, okay, well, what price exactly is going to be the clearing price?
Let's get to a single name. Let's talk about Intel. Shares rising as the chip maker's blowout forecast proves a longer-awaited comeback. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome. What stuck out for you in that earnings report?
The fact that the turnaround seems to be working finally, and they projected an outlook where they see things improving. I mean, they're not going to reclaim their leadership that they used to have, given the size of NVIDIA and how fast NVIDIA is growing. But with all this CapEx spent from the hyperscalers, Intel is now getting a small piece of it, and that's good news, given how long this turnaround took.
Mandeep, just to reflect on the hyperscalers yesterday and how the chips performed, the fact that we punished Alphabet and Tesla for higher spending, but chips didn't rally. Now, Intel's an exception, of course. Fantastic earnings. The stock is up by 5%. I'll spend some more time on that name in a moment. But Mandeep, I want your reaction to the fact that we punished the spenders and the recipients of that spending in yesterday's session.
I mean, look, there are reactions like this from time to time where you kind of see a ceiling. Trees don't go to the sky, in terms of how much the estimates will keep going up. And at some point, all these higher component costs will cause demand destruction. I think that's a big risk. We are already seeing that in terms of the consumer devices. Everyone has tempered their expectations. But I think at the end of the day, everyone wants to use this technology. The token demand continues to go up. So from that perspective, the trend is intact. And there will be some shakeout like you guys were discussing, but the overall trend is still, upward revisions. We're talking about $1 trillion in CapEx for next year, and the consensus view seems to be getting there as well.
Mandeep, thank you, sir. Enjoyed your coverage this week. Busy week for you next week, too. Mandeep Singh there of Bloomberg Intelligence. What a slate of earnings we've got coming up next week. Meta, Apple, Amazon, Microsoft across 2 days with the Fed sandwiched in between.
So if you thought that, we were not that interesting today, maybe you can just wait till next week. Microsoft, though, particularly interesting because they've got to give a forward look for the year ahead. It's their full year fiscal report. Very curious to see what that looks like.
Let's talk about Intel a little bit more. Angelo Zino of CFRA maintaining a buy rating on Intel, a 130 price target, writing, "We believe the shift towards greater AI inferencing and AI agents creates a sustained growth opportunity for CPUs and expect strong results through 2027. Angelo, you and everybody else in this market, apparently, because that stock is already up 170%. And I don't want to force the narrative, and Angelo, welcome. I'm looking at this price move this morning of 5%. And I think about Intel so far this year, and I just think, oh, only 5%. I remember a time when that would have been 10, 15, maybe close to 20. Angelo, what does that tell you about price and positioning around this stock?
Yeah, John, and thanks for having me. So when I kind of think about just obviously maybe the lackluster gains that you're seeing here pre-market. I mean, clearly you pointed to the gains that we've seen this year thus far. I think we're at a point now within the semiconductor cycle where everybody is just kind of looking to maybe digest some of the gains that we've seen here in the first half of the year, especially from the more momentum-driven names, and clearly Intel being one of those momentum-driven names. I think at this point in time, the numbers matter less. Maybe they still matter actually a lot for Intel because Intel's more of an execution story relative to other chip makers out there. But as you kind of look ahead over the next couple of quarters, I think it's going to be more some of the derivative plays out there. It's finding another Anthropic. Does OpenAI, finally show a good growth story going into 2027 ahead of a potential late IPO next year? We need to start seeing more kind of these AI monetization stories really show up into the market for the street to really believe and maybe kind of throw that next leg up to the semiconductor trade here.
Angelo, let's just stick with Intel for a second. Is Intel's gain NVIDIA's loss in the respect that they're talking about CPUs that are less compute intensive and are a different type of chip than what NVIDIA really specializes in and can charge really significant prices for? Does that signify a shift in terms of demand by the base clients?
Yeah, I mean, Lisa, I think that's an interesting point. I think clearly the shift towards inferencing is, I think the demand. I think the way this works maybe is you just get a bigger piece of the pie or growth from the CPU side of things. AMD just had their AI event yesterday, and they basically came out and said, hey, listen, CPUs are going to grow from about a $26 billion market last year to a $220 billion market by the end of the decade. So there's massive growth there, less so on the GPU side of things. So, from that perspective, the pie continues to get bigger, but certain pieces of the pie get a lot bigger than other pieces. So maybe in terms of, does it hurt NVIDIA? Not necessarily, especially since they're kind of getting into standalone CPUs, and, they'll benefit from the CPU trajectory as well, but maybe less of a benefit for NVIDIA, maybe relative to an AMD or an Intel.
There's a fear hanging over right now, a lot of the tech names, which is that we're overbuilding, and we're actually overbuilding in a really significant way with a lot of financial debt tied to it. Yeah. How do you determine when we've crossed that Rubicon?
I think I don't think anyone can really know when or not we're going to get to that point. I mean, clearly, what you want to see is you want to see healthy spending. You want these hyperscalers to be very responsible in nature. We did see Alphabet kind of hit the negative free cash flow here this quarter. That's not necessarily a surprise. I mean, especially when you kind of look at what Alphabet is seeing on their cloud side of things, and not to mention when you look at the balance sheet there. I think they're just kind of raising debt in order just to kind of have that flexibility that's out there. But yeah, I mean, you want these guys to be very responsible in nature. You want to see this accelerating growth, which you're seeing, and I think you're going to see pointed to from the likes of Amazon and as well as Microsoft here in the second half of this year. But in the same respect, you want that at least as a percentage of the increases from on the spending to start to moderate a little bit. I think you'll start to see that as we go into 2027 and 28. But in the same respect, I expect these companies, at least over the next 2 to 3 years, to fully blow out all their free cash flow. And I think that's something, whether or not the equity markets are okay with remains to be seen. I mean, clearly those multiples have come crashing in based on the fear that, hey, listen, we're not going to see any of that free cash flow here over the next couple of years.
Angelo, on Intel, given the fact that they had an amazing earnings report, strongest revenue growth, as you noted, in 15 plus years, when it comes to this company and this latest earnings report, could it be directly correlated back to the U.S. government taking an equity stake?
I think that was an important inflection. I think that was, an unbelievable investment that was made by the U.S. government. I think it helped really kind of save Intel in many respects. So to answer your question, I would say yes. I think the momentum that you can continue to see here over the next couple of years, and I think Intel is very different than a lot of the other chip makers because they aren't a fabless company like most of these U.S. chip makers are. They've got that manufacturing business. So the geopolitical uncertainties out there are another story to Intel, in addition to the AI thesis that's out there. So in our view, geopolitical uncertainties will continue to increase, especially with what's going with the uncertainties in Taiwan. And as a result, I think you'll continue to see that push and greater spend into Intel's foundry business, which is a big crux to our thesis and our kind of longer term view that there's some sustainability here for Intel as we go into some of these out year estimates.
A key national security objective. Angelo, good to see you. Thank you, sir. Angelo Zino there of CFRA. Stock is higher now by 4%. That's one to watch into the opening bout. Let's see if that holds on to gains. I think that's going to be quite important. You've got some blowout earnings, a lot of enthusiasm around the name. It's had a big run up. Stock is pretty aggressive up and to the right. And it's up this morning by 4%. It's worth a little look into the opening bell.
If it doesn't hold, that's going to be a pretty bad sign, especially considering how big the beat was. Their profit beat by double. It was twice as much as expected, just to give you a sense of how much of a blowout this was.
This is what Max Kettner of HSBC was talking about. It's not just about the earnings. Earnings will be fantastic. It's about how this market responds to them. That's one to watch.
I caught up with him briefly yesterday.
What did he say?
Are you now bearish? And he said, not yet. You got to wait for all of them to come through.
Yeah.
Idiosyncratic things can come to the fore. So he's waiting until next week.
It's the price action of Thursday morning after Wednesday and Friday morning after Thursday that maybe he's waiting for into the weekend next weekend.
Yeah, so let's see how this all shakes out.
Yeah. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Volkswagen cutting its sales and delivery forecast. Europe's largest car maker saying revenue could fall as much as 3% as it faces a deepening slump in China. Volkswagen shares are off more than 30% this year as CEO Oliver Blume struggles to overhaul the company. AMD announcing new products for data centers it says will outperform those from rival Nvidia. The chipmaker unveiling new generation microprocessors, an updated AI accelerator, and a new server design. Another setback for SpaceX. Elon Musk's company delaying a Starship rocket launch due to unfavorable weather. It'll try again this evening. The rocket will be carrying upgraded Starlink satellites that are intended to burn up in the atmosphere as part of the test mission. And that is your Bloomberg Brief. John.
In some ways, that's become a market event. Vonnie, appreciate it. Thank you. Up next on the programme, hovering near triple digits.
We're looking at a low $100 range, 100 to 110 in the coming weeks. But the risk is way to the upside because there's enormous optimism in the price. And I think that optimism is unwarranted.
Rebecca Babin of CIBC joins us next, live from New York City. You're watching Bloomberg Surveillance. So this is the bounce from the biggest one-day loss of the month so far. It's small. We're only up by 0.2% on the S&P. The down week is small as well, and I think that's worth pointing out. Yes, we've had 2 days of losses, but on the week we're lower by 0.66% so far on the S&P. So just bear in mind, yes, a lot of violence in this market beneath the surface. Not a great choice of word. Beneath the index. At the index level, still pretty subdued. Still 2 to 3% away from record highs. On the Nasdaq, up a tenth this morning. In the bond market, 2s, 10s and 30s, still near the highs of the year at the front end of the curve, 433. Yields coming in 2 basis points. You thought we got away from 420 with softer CPI, softer PPI, and here we are again, going into the Fed's meeting just next week and setting the tone for the price action in the last 24, 48 hours. This move in crude holding on to gains just about. We're down by 2 to 3%. Brent crude, $98 a barrel. Under surveillance this morning, hovering near triple digits.
We're looking at a low $100 range, 100 to 110 in the coming weeks. But the risk is way to the upside because even as we sit here today, there's enormous optimism in the price. And I think that optimism is unwarranted. And I think that bubble could burst. And if so, we're going to reprice much higher, I'm afraid.
So here's the latest this morning. Crude set for double-digit weekly gains as the war with Iran intensifies. Brent briefly hitting its highest level since May. Rebecca Babin of CIBC writing, rather than asking whether the market can absorb today's disruption, traders are increasingly asking whether the current set of solutions has enough runway to absorb tomorrow's. Rebecca joins us now for more. Rebecca, welcome to the programme. I think that's an important statement to make, so let's think about it a little bit more. The shock from late February into early March, we struggled to hold on to the gains in oil. We started working through massive levels of inventory. Do you think the setup, the backdrop is different this time?
Yeah, I do think the backdrop is different this time. Clearly, we're in a situation where inventories are meaningfully lower than they were when we started this conflict. We've seen the SPR go from 415 to now 313. So that's a significant drop. Commercial inventory is also lower. But I think it's important, Jonathan, to point out something that has also happened. We've seen China really reduce their imports of crude oil, and they've acted as this kind of invisible hand, allowing the market to recalibrate and not draw down as much inventory as we would have modeled when this conflict originally happened. So it's not that the inventories didn't draw, they did. They didn't draw as extremely as predicted, and there's been some offsetting factors which have buffered kind of the price move. So the setup clearly is different, but the market's resiliency also has proven to be stronger than I think was initially expected as well.
That's at the crude level, but what about the product level? China has been hoarding when it comes to actual products. Isn't that where the real problem is?
Annmarie, you bring up a great point. Products is really where the story is at, I think, in terms of tightness. China did actually ban exports. They've rolled that back over the last several weeks, but they haven't been extremely aggressive. Products just do not have the same level of buffers in the system. Refining capacity is constrained. We're running at 96% in the US. There is very limited sources of excess product. We had Russia products that were, really helping out the market. They put on an export ban, and we're seeing diesel prices, as you mentioned earlier in the show, really moving kind of more parabolically higher than linear as crude is moving. So yes, that is, I think, the bigger risk in the market, but that is also more priced in. Right? So we didn't see the pullback in diesel and gasoline the way we did in crude oil when that sell-off has happened. So as the risks are higher, but the pricing is also higher as well.
When it comes to the United States, gasoline is now $4.10 across the United States. Do you think by the end of the summer we're hitting $5?
I don't think we're hitting $5. I think we're probably going closer to the $4.25, $4.30 level. And that really depends on what happens from here. If we continue to see Hormuz fully restricted with only a trickle going through and also Red Sea flows impacted, yes, I think we're going back to kind of that 450. If we also continue to see Ukraine target Russian refineries, I think, again, 450 is very realistic. 5, I think, is going to take more duration of this. We would need to see several months of this before we kind of hit that level. And keep in mind, in several months, we're kind of out of summer driving season. So the peak here is the next month. And I just think we have enough inventory, just enough. Keep in mind, Europe has not released as much of their SPR as they have announced. US has. Japan has. There's still a little bit of SPR, I think, that can come out of Europe. So I think over the next month, maybe 420 is where I'm looking.
How much do you think that this market isn't responding as quickly as some people would otherwise expect to the renewed tensions in the Middle East because of their being conditioned by experience, because of what happened over the past number of months?
I think there's a very significant component of that. And the where I see that is in the option market. Yesterday, Brent options broke their all-time record. The most active option that was traded yesterday in Brent was a put. It wasn't a call. So yes, there is a condition in this market mindset sentiment that rhetoric escalates and de-escalates. And when the rhetoric de-escalates, we go from worrying about scarcity to worrying about surplus. And that 2020 surplus of 2 to 4 million barrels, depending on who you talk to, is the overhang that drives a lot of that negative sentiment. I don't want to be caught long right now. If the rhetoric de-escalates, I'm looking at this huge surplus in 27 and prices are going to recalibrate in a heartbeat. So that's clearly part of the trader mentality, as well as the fact that, we've gone up and down a lot here in volatility. People want to preserve P&L as we head into the weekend.
Rebecca, it's good to see you. Thank you. Rebecca Babin there of CIBC. Some risk heading into the weekend, obviously. My goodness, China has not helped out much with the Strait of Hormuz. But boy, have they helped out much with the price of crude. The price of crude would be a very, very different number without them making a move.
Yeah, and frankly, without a lot of people just quickly shifting to electric vehicles and other non-gas using ways of creating energy. How much does this last? How much is this a permanent shift? And how much is this something that potentially could be brought back online if it persists for long enough?
Quick note on Bank of America in the pre-market, slightly positive. Some news from them just moments ago, increasing their common stock dividend by 14% to 32 cents a share. This from Brian Moynihan. The increase in our dividend reflects the strength of our earnings, the power of our franchise, and our confidence in Bank of America's ability to drive long-term growth and create value for shareholders, following some pretty decent numbers from them in the last few weeks. That stock is up in a pre-market. Up next, Dan Greenhaus of Solus, Monica Guerra of Morgan Stanley, Michael Ventura of RBC, and Republican Senator Dave McCormick.
People are not acting like they expect higher inflation.
I just don't think that we're at the point where we're seeing widespread inflation.
I think the economy can well withstand $100 oil.
We need to start making a distinction between what might be called good hikes and bad hikes.
More likelihood of a hike than a cut, without a doubt, this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. It's a small bounce from the biggest one-day loss of the month so far. Equity futures up by 0.2% on the S&P. On the Nasdaq, not even up by a tenth. Notable, given the damage to that index yesterday. In the bond market, 2s, 10s and 30s, yield holding onto these levels. 433 on 2s, 10s just about unchanged around 470. That's what's different about this moment. We're getting up there and then holding on to it. So you've got the energy shock to think about too. Brent and WTI holding on to those levels as well, around $100 a barrel on Brent crude. And Bramo, we've talked about this. Energy shock, rate shock, haven't had the growth scare. That's why you're holding on to these levels.
Even in Europe, which some people had left for dead, they came out with better than expected PMIs earlier this morning, that actually their growth had accelerated much more than people previously expected. When you see corporate earnings here in the United States, its resilience, its expansion, its profit margin, profit margins continuing to go up, and you look at all of this and you say, when does it get disrupted? So far, we haven't seen that sign. I mean, take a look at, for example, airlines, with the exception of American Airlines. They've all been able to pass along those price increases and see earnings that were better than expected. When do we reach the tipping point? And I think a lot of people are wondering that this morning.
And it's an important question going into this weekend, as the president is saying that potentially he's going to have to expand the strikes on Iran. They are trying to get the Iranians to capitulate. The fighting continues. Inventories keep shrinking. We're living really on the edge when it comes to inventories. We just heard from Rebecca, who talked about how we're at 97% refinery capacity here in the United States. On top of all that, a new risk in the Middle East has been reintroduced.
What is it about Bank of America? Not Bank of America, American Airlines.
Oh, yeah.
American Airlines. Bank of America on my mind because they increased their dividend. But you mentioned American Airlines. They're just like the odd one out for the big airlines right now. Why?
Well, yesterday they said that they actually downgraded their full-year forecast for the second time in the past couple of months, and they said it was because of fuel bills, and they said that what you had seen was a significant deterioration over the past month. We talked about how diesel prices are up dramatically, jet fuel prices are up dramatically. That said, is there something else with the hangover of debt, how they're issuing that with respect to the routes, with respect to how they compete with premium offerings that's put them on a back foot? Increasingly, a lot of people thinking about that.
The Ferro family moved away as well.
That was the
I've been moving away too.
It's going to ding American Airlines.
You think that's sort of like that was the signal?
I have always been committed to one world. So I lived in London. You have to fly British Airways, right? And then also Qatar Airways when I go to the Middle East. So then come back home, I'm flying American. Now I fly Delta. And you know who emails me? Every morning I get an email from who?
Oh, do you?
Delta Airlines.
Do you?
Every single morning, there's an email popping up. They want your business.
Do you want to derail the program, like for a couple of minutes?
Sure.
Just totally derail the show, kill the music. We're talking
I know
about
where
airlines.
we're going. Let's do it.
I got the call. I got the call from American Airlines. So I talked about my experience on the program. They called me up and they said, what can we do? And I explained to them what had been happening with the family. I said, the mother-in-law, 5 million lifetime miles with you, flown with you for decades, had concierge key for years, stopped flying with you. You never called. She's disappeared. She now flies with Delta. The wife, Mrs. Ferro, concierge key for a couple of years, whatever, executive platinum forever, flown with you for decades since she was a small child, up and down to Latin America with business. She stopped flying with you, went on maternity leave, lost her status, she never called. She had to call you, and then you told her that if she wanted to stay with concierge key, she had to pay for it, right? So I said, so we've moved on. I said, the problem you've got now is if you start at zero in New York City, and let's say you've got no status at all, and you fly business with work, lucky you would fly Delta in a heartbeat. You get status straight away because you get to go to the lounge. You get to use Delta One. You get expedited security through JFK, right? You can go straight through JFK. Terminal 8 with American Airlines, you can't do that. And to use the good lounge, you've got to wait a while to get status, to then use the better lounge. So you're going to end up in a bit of a zoo, a bit of a cafeteria that you probably want to avoid. And that's the situation American Airlines are in. And when they called me, they called back a few days later. And they said, we can't do anything about it. We can't restore your status. And I turned around to them and said, not a problem. I don't want anything, but here's what you should do. I suggested to them they should introduce a program that when people go on maternity leave, they can lock their status. So when they come back and start working again and start traveling, they'll stay with you. Brand loyalty. Maybe you should introduce that.
That's a good idea.
Right? I also suggested that for people that have flown with you forever and suddenly disappeared, maybe you should call them and find out why they're now flying with a different airline. And I've got to say customer services were really receptive, but I just don't see the executive team making the kind of changes that are going to keep those high-value flyers.
There's a bigger point here, and this goes to how a lot of companies are using artificial intelligence. If you have a proper screening program to identify key people, key customers, and then cater to them with a way that's more efficient, you deliver better results. And that is why a lot of places are needing to invest in technology just to be competitive, to stay competitive. Because ultimately, how do you do all of this on scale? And you have to do things like this. You have to move the premium offering in real time. And so this is exactly what we're seeing under the surface about how it's getting deployed.
You got a phone in this morning, just dial 1-800, complain about an airline. Bloomberg Surveillance.
Is that what Twitter's for?
We should move on. Let's talk about markets. Coming up, Dan Greenhaus of Solus with stocks struggling to find a firmer footing. Monica Guerra of Morgan Stanley on how rising prices will impact the midterm elections. We'll catch up with Republican Senator Dave McCormick on his favourite airline. We won't do that. We'll talk to him about the president weighing a massive attack against Iran and the serious situation in the energy market. We begin this hour with stocks searching for gains and crude hovering near triple digits. Dan Greenhaus of Solus Alternative Asset Management writing, with yields and oil moving higher, it probably means the market's consolidation phase is going to continue. Dan joins us now for more. Dan, good morning. Good to see you. Anything to add? Come on, please.
I have something very important to add. I'm concerned that extended segment will eat into my face.
No, you're good. I promise you're good. You're good.
Okay.
Are you on the edge of bearish?
I'm not on the edge of bearish, but listen, as traders... But we have to account for the fact that something is going on here. Oil prices are going up, yields are going up, and with the investor skepticism, for whatever phrase you want to use, regarding the Mag 7, the market's been trading sideways for a couple of weeks now, and that's probably going to continue as we work our way through this higher yield, higher oil environment. Now, that said, I'm going to keep going here because I feel like my time was stolen for your complaint department. American Express is on the tape this morning. Revenues up 10%, card spending up 9%, XFX.
Guidance a bit firmer.
Guidance firmer, and from the press release I'm reading here, quote, 6 months into the year, we're seeing stronger momentum than we expected. Now, we all know American Express caters to a higher income cardholder, sure. But when we talk about, well, I'm seeing weakness over here and I'm seeing weakness over here, for many years now I've come on air and said, look at the card companies, because they see spending across categories. And obviously American Express is usually the first one out, but I imagine Visa and MasterCard will follow suit, reiterating and reinforcing the idea that the consumer is still doing pretty well.
I'm with you, and that's what's unique about this moment, that we've had the energy shock, we've had the bond shakeout, we haven't had the growth scare. And I just wonder, in your mind, when you look at these yields right now, what is sustainable? What kind of yield level can we sustain that this market's comfortable with, this economic backdrop is comfortable with?
Yeah, it's higher yields are worse, all else equal, than lower yields, depending on your environment. And certainly as you get up closer to 4.75 and 5, that gets a little more difficult for longer duration equities, et cetera, et cetera. But part of what's going on is the higher price in oil, obviously. Oil is one of the most, if you're going to think about inflation and forecasting inflation, oil is one of the most obviously important inputs. But eventually this conversation turns to the Federal Reserve. And some part of this is increasing odds of rate hikes, maybe not next week, but over the next couple of months. And I think if you're the Federal Reserve, you're in a really tough spot here. You have been for some time, but even more so now, because you have to disentangle why are inflation pressures higher? Why are they, obviously they have missed their target for multiple years now. And if you look at some of the drivers, dare I say most of the drivers of higher inflation, I'm not sure that a rate hike will do much about it. There's a war in the Middle East. Oil prices are higher. Higher interest rates are not going to do anything about that. We keep getting tariff headlines. They are equivalent to a sales tax hike. There's nothing that a rate hike is going to do about that. Obviously, there's underlying demand issues and et cetera, and that is something you can do something about, although they have told me for years they are unwilling to do something about that. But for those two near-term main drivers of higher inflation, which is pushing yields up, I'm not sure a rate hike is the solution.
Do we need a growth scare at this point, given the fact that oil prices continue to go higher, that inflation has remained higher for more than 5 years?
I don't think you'd ever need a growth scare. But
I ask this because that seems to be Europe's playbook, and that's honestly what a lot of people are thinking about. I mean, right now, the rates market is saying, give us a rate hike. And you're saying that the Fed doesn't need to deliver it. So there is a conflict here.
Well, I'm saying the Fed probably doesn't need to deliver it. I'm not saying they don't have to.
I'm laughing because I'm totally with Bramo that the Europeans just engineer growth scares. Right?
How's that working?
I'm going to take so much stick for saying that, but that's what you're saying.
True. I mean, that's essentially what they are saying. So in the U.S., we're saying we don't need to, but the market is trying to engineer a rate hike. And so if they don't deliver one, does that become a problem, or is that going to be a boon to the equity market?
Well, I'm not sure the market's trying to engineer one. I think in the new era of less Fed guidance, everyone, I'm sure, has come on air. I watch quite often, but not all the time. And I'm sure everyone comes on air and says, in addition to the era of less guidance, you're going to have an era of higher volatility as the market prices in what it thinks the Fed should do as opposed to what the Fed will do. Because in the past, they have told us more or less what they would do in the post-GFC era. So, yes, the market is struggling, for lack of a better word, to figure out what the correct policy course going forward is. And maybe next week we'll get greater clarity on that. All I'm saying is some of those drivers are not suited to rate hikes. And I think the Fed has to be very careful here not to exacerbate the situation. Now, in terms of a growth scare, the economy is doing fine. Jobless claims yesterday, since the doors were on the charts. You mentioned ISMs in Europe, et cetera, et cetera. There's no real big, obviously there's some issues at the lower end of the income spectrum, et cetera, but you listen to the United Rentals report, the Honeywell report, et cetera.
Well, then why aren't you getting bullish in terms of the sell-off being a viable dip?
We're like a percent and change off the high.
Not
I was watching TV yesterday.
7.
Well, yes, the NASDAQ is down 7 and change percent. That's fair. But for the broader market, and I think many investors, well, I shouldn't say that. I was going to say many investors are broader market investors, but they might own SpaceX and
What were you watching on TV?
I watch all sorts of things.
Well, you were just about to say I was watching on TV.
I was watching some things on the TV.
Yeah, and what did you see?
I saw some person say something that I disagreed with.
And what did
which
they
is
say?
Not unusual.
What did they say?
I don't remember anymore.
Okay, all right.
But so...
He's not trying to start a fight here.
No, I'm not trying to start a fight. I enjoy all the TV and the people that I watch and the meetings that I have with investors. Everyone is wonderful. And so getting back to the main point here. I remember now. Someone was saying, are you using the sell-off opportunities as a chance to buy? And sure, that is applicable to many of the tech names that are down a bunch. Right. Sure. But for many investors out there that invest in something besides technology, a lot of these names are barely off the highs. Look at the chart of Simon Property Group. Not that long ago, malls and retail was the short of the century. Pull up a chart of Bill in the control room. Pull up a chart of SPG.
I thought it was Bobby in the control room.
He might be out today. It's Friday in the summer.
Bobby was fired.
Summer Friday.
Like a lot of these Ross stores, there are other things doing.
So I'm with you. And when you look at the index, if you've been away for vacation for a long time, it's done nothing since the end of June.
Yeah.
We're 2 to 3% away from all-time highs. But earnings have been fantastic.
Yeah.
What we're trying to gauge here, Dan, and I think it's an important conversation, is the index going to stop going up even when the earnings are so good? And there's a signal that you can take from that the market's no longer responding to that fantastic information in quite the same way it was.
Fair. There are something I think a lot of us who speak about markets struggle to articulate is the two seemingly divergent ways you need to look at the market. With respect to earnings, there's two analyses. Are earnings good, and are earnings good enough? If you're an investor, as we are and many are, all you care about is are earnings good enough. Good or bad doesn't matter. Good enough is what matters. If you're an economist, if you're looking for a signal from markets, good is all that matters. Yes, Netflix revenue growth was 11%. The market wanted 12%. Stock sells off, but 11% growth is still pretty good. I'm picking a random earnings report out of the air. Those earnings reports, I mentioned United Rentals and Honeywell and a whole host of other companies that have gone this season. I don't really see much weakness. I mean, Comcast talked about Epic Universe. Maybe there's some. I was just down at Epic Universe. It didn't seem like there was much of a problem to me. But Comcast said that maybe there's some trouble down there, and maybe that signals weakness for Disney. But across what I've seen so far, 100 plus S&P 500 companies, I hear pretty good things.
Who'd you fly with?
Who did I what?
Who'd you fly with for your vacation?
The CEO of Delta actually came with me. He wanted to make sure that I had a good experience.
See, he's very good at customer service.
And no, I went with my family down to Epic Universe. We went on the rides, and the Super Mario. My son is young. We went on the Super Mario World. It was fantastic.
Very cool. Are you satisfied with your time allocation?
No, I'm never satisfied.
A little bit more, or you?
If there's one thing you know about me, it's that I always
more TV. He's thirsty.
More. I love the sound of my own voice, sir.
No.
No.
Dan, thank you. Appreciate
you for having me.
Dan Greenhaus of Solus Alternative Asset Management, other networks. Dan is available for appearances. He wants to be invited still.
Weddings and bar mitzvahs?
He saw things on TV that he disagrees with, but that's okay. He sees lots of things on TV he disagrees with.
But he can go talk about any of them, including his time at, Orlando.
Let's give you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. The U.S. launching its 13th straight day of strikes on Iran. President Donald Trump threatening to escalate the attacks and saying it'll hold Tehran responsible for actions by the Houthis. Axios reporting Trump is considering a, quote, massive attack and is close to making a decision. The federal government dropping subpoenas compelling New York Times reporters to testify about anonymous sources. The probe related to the subpoenas came after the Times reported on security concerns over Trump's new Air Force One jet, which was donated by Qatar. SpaceX betting big on Starship. Sources telling us here at Bloomberg, Elon Musk's company is turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028 as it plans to transition to Starship. The company declining to comment. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, keeping an eye on the cost of living.
We have kept rates down, way down. Inflation is way down. The Democrats in Congress, if given the chance, they'd send your prices soaring and inflation skyrocketing.
Up next, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. Equities bouncing this morning by just 0.2% on the S&P 500. Under surveillance this morning, keeping an eye on the cost of living.
We have kept rates down, way down. We inherited the worst inflation in the history of America. Inflation is way down. The Democrats in Congress, if given the chance, they'd send your prices soaring and inflation skyrocketing.
So here's the latest this morning. The White House touting efforts to fight inflation. The president announcing an expansion of the ratepayer protection pledge. The president now scheduled to deliver an economic message in the key battleground state of Michigan on Monday. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, this weekend will actually mark 100 days until the midterm elections, which will hinge in large part on these voter concerns around the economy. And as you mentioned, those fears are now being compounded when it comes to the higher costs associated with AI development. President Trump yesterday touting this bipartisan ratepayer protection pledge, which essentially puts big tech companies like Amazon and Meta on the hook to pay higher electricity costs, essentially funding generation and power upgrades. Though this is only one part of the economic picture that voters are contending with. A new poll this week from Fox News finds that Democrats now hold the advantage over Republicans when it comes to who voters trust for the handling of the economy and inflation. Of course, two issues where the party has typically been the stronger one on. And John, so far this week, the Trump administration is doubling down on its economic policies, being perhaps the busiest week in months when it comes to the tariff agenda, though a senior administration official tells me to expect more exemptions when it comes to the tariffs that were just announced overnight on goods that could contribute to supply disruptions as we get closer to November.
Tyler, thank you. This will be a major issue getting closer to November. Monica Guerra and the team over at Morgan Stanley writing in their midterm election preview the following. Even when growth is resilient, voters often discount healthy macro data when their lived experience is defined by higher costs for gas, groceries, rent and utilities. Monica joins us now for more. Monica, good morning.
Good morning.
It's good to see you. This is going to be a major issue into the midterms. What can you do between now and then if you're a policymaker?
If you're a policymaker, you're looking for every avenue. I think that the Trump announcement around corporations contributing to power generation and trying to reduce those costs is one of those measures. But you have to balance that with what's happening geopolitically and globally when we see what's happening with the U.S. and Iran, pressures on gas prices, right, and that elevation, as well as concerns at the local level just around housing, and that's more of a local issue, not one that the federal government can just come in and cut.
It's the last week of Congress in terms of before their summer holiday that you have both the House and the Senate in session. Gas prices are going up. Americans are pushing back in polls about this war. Are they going to do something when it comes to at least some of the immediate effects at the pump?
So what's really interesting about this is that you see, like you said, it's a really unpopular war. About 59% of the population is not in favor. And Congress has actually moved, to rebuke the president. A Republican-held, House has rebuked the president with this GOP, War Act, saying that they are not in favor of continuation. However, Senate's not going to move on that, so it's mainly symbolic. And in the same hand, right, one hand you're saying, we're not in favor,
now they're
but then
sending
they're
more money.
approving $95 billion, right, for more spending on the Iran war. So what are they going to do? There's limited tools that they can actually pull on. Maybe you look to releasing more from the Strategic Petroleum Reserve in the U.S., but even that is very limited. We already have dwindling levels of the SPR to historic lows, and any sort of shift there would maybe alter pricing for a week or two ahead of the midterm. So you would have to really time it strategically.
The other risk this morning, of course, is the reintroduction of new tariffs. The markets seem to be brushing this off, but some analysts I'm talking to are saying their clients, corporations really care. They're going through these lists. Is this going to be an issue for this White House with some of these C-suite executives?
Well, what we've seen is that the broader, in our view, we think that the broader cost pass-through to the individual related to tariffs has peaked and is starting to come down. We have seen a lower inflation print. However, all this macro, activity could turn that tide, right? It just was a small disinflationary, moment in June. So for us, we're still, very much watching that number and seeing, what Congress and the Trump is going to do to actually move on it. Now, what's important here for us when we're thinking about tariffs in the future is the full package for the consumer and how they're going to respond in the midterms. And so from the political science lens, we're looking at gas prices, which in years where there is an increase from the prior January, you get a loss of about 32 seats. So it really puts the GOP already on the back foot, not just because historically you get a turnover in midterms, but then you also have the gas price component also dragging on the likelihood of re-election.
So that's the election picture and sort of the lead up to it. From a market perspective, I understand that I've got a very skewed kind of view on a lot of things. But yesterday I saw the data on, or the news about the tariffs, and I thought, oh, they're looking for new revenue to plug some of the gaps because the deficit's going up so much. Maybe this could help bond yields. Is that even in their calculus? Because at this point, you're seeing bond yields really get carried away and affecting some of the areas that they've been talking about the most, like housing.
Well, you have to remember that the tariffs that have been recently announced are largely symbolic, right? You're saying, Trump came out and said 100% tariffs on pharma, but that starts in 2028, again, post-election. So it's not necessarily a midterm factor, nor do I think that it's really a revenue plug because it's giving a long runway in order to get, these generics back to the U.S. In addition, when you think about the USMCA renegotiations, we've said for a long time now, over and over again, that this was going to be a pressure point for the summer. And we're starting to see that come to head on the 50% on Canada. That we think could have the biggest impact. But again, that's still an opening bid. And when you're working with Trump, you have to remember this administration, we always land somewhere in the middle. So as far as the tariff component, I think it's a little less risky than, say, the gas and U.S.-Iran piece of the equation.
I share Lisa's bias. I was looking at the bond market too.
Thank
It's one
you.
of those days.
I know. I was just thinking to myself, yes, but you were looking at it because of oil and gas. But I'm thinking, what can they do to actually cap these yields? They could, try to fire someone on the Fed, or they could potentially, try to raise revenue.
I'm not sure firing someone at the Fed would help these yields.
I know, but they're trying to figure out how to engineer a different Fed board and what that would look like. But I mean, it's sort of they're running up against a lot of challenges, so maybe more revenue.
Monica, good to see you. Thanks for being here. Thank you. Favourite airline? No, don't do it. Monica Guerra.
I'm like, no.
No. Monica Stanley, Wealth Management. Monica Guerra. Monica, thank you. Fantastic guest coming up in just a moment, by the way, to talk about some of these issues. Senator Dave McCormick. He understands the backdrop for the geopolitics better than most, and he also pairs that with an understanding about financial markets better than most. That's about 20 minutes away.
Yeah, I want to hear what he has to say, given where bond yields are and what the financing costs are. I'm also interested in what the modern warfare is and skeet shooting with...
Billion-dollar skeet shooting.
Billion-dollar skeet shooting, as you call it, yeah.
Very expensive.
How do we get away from that?
With great difficulty at the moment. Up next, we'll catch up with Mike Ventura of RBC on this equity market. Usually when you get the kind of route we saw yesterday in both the equity market and the bond market, typically you might wake up and see a big bounce, and you don't see that this morning in stocks or bonds. Equity futures this morning bouncing back by just a few tenths of 1% on the S&P. On the Nasdaq 100 higher by just a tenth of 1%. And in the bond market holding on to some of these levels. Pretty muted price action here. Yields down only a single basis point, coming off the highs of the year on a closing basis on 2s and 10s. 10s this morning, 468, 2s around 433.
The fundamental problem hasn't been resolved, which is the conflict in the Middle East, the flow of oil, and the inflationary pressures that could then ensue. You add to this some of the financing needs of the artificial intelligence-related companies. You can see that people are demanding a higher premium, and that's not going away.
Just sit on that bond market and those scores just a little bit more. Let's look at those yields. Those yields, 2s and 10s in the last 24 hours, are higher than they were at the first stage of this energy shock, and they're higher than they were for the Liberation Day shock as well. Yields have taken out those levels.
That's what I've been thinking about, because the president reversed course on Liberation Day after he said the bond market got yippy. Well, now we've passed through that level, and he's still talking tough when it comes to rhetoric in terms of what he's going to do with the conflict as well, introducing new tariffs. I don't get a sense that he's prepared at this level to reverse course.
I think that's what's unique about this week, that we've got to these levels, and you pointed out earlier this week, the buying's not come back in. There are a bunch of reasons for this, but that's a unique feature of this backdrop for this market at this point in time, that you can get to these levels across the yield curve, and we're holding on to them for a sustained period.
A lot of it goes back to what you were saying. Normally you see demand destruction. Normally you start to see cracks in the consumer and the underlying economy. You're not seeing that this time. So at a certain point, if you're seeing a faster than expected economy, inflationary pressures, and much more borrowing that needs to get done, that all adds to a higher premium.
You're not seeing the growth scare. You're just not seeing it, even with this move in crude. Check it out. WTI and Brent through triple digits in yesterday's session, backing away this morning by 3%, but holding on to 98. That was a feature of the conversation we had earlier on the programme with Rebecca Babin. Can we hold on to these levels? We struggled to maintain the highs in March, April time. Is it different? Is this backdrop different? Is the cushion small enough to make a difference?
Well, we're living on the inventories. The fighting continues, and there's fresh risks that are now introduced. Torsten Slok just put out a note talking about how much more time it takes to avoid the Bab el-Mandeb Strait going around the Cape of Good Hope when it comes to Africa. He says 9 days to ocean routes, supply chains under pressure.
That's the price action this morning on our radar. President Donald Trump imposing duties between 10 and 12.5% on imports from most major trading partners, alleging around 60 economies failed to prevent forced labor in their supply chains. Elsewhere, the president weighing a, quote, massive attack on Iran. Trump telling Axios that Tehran isn't ready to make a deal, saying, quote, they haven't received enough pain yet. And finally, Intel shares gaining in the pre-market. The chip maker reporting its fastest revenue growth in nearly 15 years as the AI boom fuels demand for semis. Intel reversing plans to reduce capex and committing to increasing spending.
Their earnings were incredible. Just to put this into perspective, their profit in the second quarter was 42 cents a share, based on the expectation of 21 cents, so double that expectation. Full year sales, 15.8 to 16.8 billion versus the expectation of 15.1 billion. Why? Because increasingly the CPUs that they produce, which are much more the nuts and bolts and less of the sophisticated chip that NVIDIA produces, are being required for the data center build out and a lot of what they're trying to do to build out computing capacity. Is this because of the investment from the United States? Is this because of some of the just the hype around what they've done? Or is this that the demand is so great and it's changing in nature and benefiting this company?
This week and the next couple of weeks for me and many others was never just a test for earnings. It was a test of price and positioning. And this story with Intel, I think, is a decent case study of that. It's had a monster run up. What were we up year to date? 170%, something like
bonkers.
That. OK. Earnings are a blowout. You look at those earnings, they're absolutely fantastic. Look at that stock move. 3 to 4% for a name that, you know, so you've blinked some days and Intel's up 10% sometimes, right? This tells me something about price and positioning. And the last few days have told me something about price and positioning too. There's not a problem with earnings, but it speaks to price.
People's bar is incredibly high just based on where valuations are. Samsung, though, didn't work. I mean, even when they did have blowout earnings, their shares fell. So the fact that Intel's shares are up probably gives some people confidence that there's something left and that there still is some modicum of surprise available, at least if you really do have an incredible earnings.
Yesterday was odd too.
It was.
You're punishing the spenders and the chip stocks don't rally.
It was a puke day. I mean, it was an everything, sell everything kind of day. It was sell the levered trades kind of day because ultimately nothing was going to work if oil prices get incredibly high.
Do you want to congratulate the president for his timing, his market timing with this particular stock? It's not bad, is it?
No,
how much money have they made on this?
They've nailed it on Intel. They have.
Totally.
Billions of dollars. And, well, what happens with it? Is this going to be some sort of sovereign wealth fund? But at the crux of it, it is about, with a company like Intel, which is why some Democrats were in favor of it, it is about national security.
Do you know what I'd worry about? And you're absolutely right. And I think we've sacrificed the free market and capitalism for national security. It's difficult to argue with. You need to develop the kind of production that we're developing with Intel domestically here in the United States for a bunch of reasons. Good news. Like anyone who gets involved in financial markets, when you get onto a winner early, sort of get emboldened. You're like, I'm good at this. I'll start buying a little bit more. That's what worries me about Washington, D.C.
Well, they might be doing that with AI companies.
That it sets the tone for a new era of very activist White Houses looking to make the same kind of investments. And I would warn Republicans that if you're comfortable with this, just wait, because it won't always be Republicans in the White House, and Democrats will have their own ideas on the right things to buy, and we'll have a different problem.
Let's see where this goes. Right now, Intel made a lot of sense. Let's see about getting a stake in it.
Brammer doesn't want to go there. Intel up by 3.5% this morning. Let's stick with the AI build-out. Investors weighing the soaring price tag of the big tech arms race. Alphabet boosting spending plans for the year, signaling hyperscalers may continue to tap markets to fund their ambitions. Michael Ventura of RBC writing, the equity market was already showing signs of fatigue. Anytime you have a market that is fatigued and overwhelmed with issuance, you're likely to see an outsized reaction. Michael, a fantastic guest, joins us now for more. Good to see you, buddy. Thanks for being here.
Thank you for having me. I have wanted to jump in for the last few minutes. You have highlighted a number of points that I think are germane to this discussion. The names that you have mentioned are some of the best business models in the history of capitalism. Many of them had blowout earnings this week. A lot of the news flow, from a macro perspective that you highlighted, is not new news. It's new cares. The market decided to care this week about a lot of things that they have been able to compartmentalize in a way that we perhaps have never seen before in history. Some of the news flow that you talked about would historically be macro events that would shut down the capital markets. We have looked past them, looked through them, and some of the issues that you highlighted are now problems that are sort of 6 inches in front of our face in terms of the AI spend, the build out. We've crossed the chasm, that we have been creeping towards with respect to will folks see free cash flow, see CapEx outstrip free cash flow. We're here. We're going to raise capital into it to support it. And so I think market now, despite the fact that we've lived in this world for the last couple of years, where there's this very highly concentrated group of systemically important publicly traded names, we're at the part of the programming where there's a quality curve being established even amongst those systemically important names. And that's going to be, I think, a fascinating, next wave of this thematic.
Can you describe the issuance window and what it looks like now, given the amount of supply we might see in the next 12 months?
Yeah, from an IPO perspective, we certainly saw some clients that decided to forego entering this July window. I suspect that they will look to access the next open window post Labor Day. I suspect that'll be a very, very active window. There will be great breadth to the folks that attempt to enter the market in that window. IPO market in particular, largely concentrated around industrial names, space tech, defense tech, some of those thematics. We're starting to see a diversification into some consumer names entering the market. But I do think that September window, which is the next most practical one, will be exceptionally busy because there were a high volume or high number of names that were already in the backlog. Add to it the folks that decided to forego the July window.
Do you think that some of the highest profile potential IPOs on the docket, and I'm talking about Anthropic and OpenAI, have been stymied somewhat by some of the recent news and, frankly, skepticism around open source models and just the changing dynamic of where value creation will come from?
Yeah, I think, obviously we're not in the business of mentioning single stock names, so forgive me for sort of talking around some of the specific names that you mentioned. I do think those will be the drivers of some continued seminal capital markets events this year, like we saw with SpaceX earlier this year. I do think institutional investors, by and large, believe that we are in a great industrialization, that the spend and the capital raise behind this thematic is warranted, should continue. Their dollars will be there to support it. Do they need to own 5 railroads, I think, is a question that a lot of institutional investors are asking themselves right now. And so, again, I think we'll start to get into the part of the programming where we pick some real winners and losers amongst even this very concentrated cohort of again, very systemically important and highly valued names.
What signals from the market would you say, hold on a second, this might be a closing of the opportunity to raise money in the equity markets akin to what a lot of people have been planning for?
Great question. And I think one of the things that gives us a lot of confidence in this capital rotation that we're seeing happen right now, if you go under the hood with some of the volatility that we've seen intraday in the market, It's momentum down dramatically over the last 30 days, growth down dramatically over the last 30 days. It's a reallocation of capital into other parts of the equity market. It's not a withdrawal of capital from the equity market, flight to safety. You mentioned some of the bond market moves at the opening of this segment. If we had seen rates move more violently to signal that there was a real reversal of flows out of equities into bonds, a real flight to safety, that would have given me pause or indicated that maybe the window is closing. I think, again, there's a little bit of fatigue, a little bit of digestion. It's been a historically active issuance market. Institutional investors have also done incredibly well. And oh, by the way, it's August next week. And so this is sort of a time in the market when folks tend to try to take a break. And so I think we've all been rooting for that. I can say, having wall-crossed institutional investors on transactions over weekends in the first half of the year, folks are sort of looking for a little bit of a pause to the issuance pace.
For a Friday.
Right. Don't remind me that the summer's almost over. I'm starting to feel a little bit depressed now. When it comes to investors and how they're feeling right now about the AI data center build out, do you think some of it is also concerned that they're going to spend all this money and then certain states are going to say, actually, we're not going to allow this?
Really interesting developments from a political front, particularly here in New York over the last couple of weeks. I think that is a question that we'll end up working through. It'll obviously be a topic of concern in the midterms. Again, not new news that there are midterm elections coming up, but folks have decided to focus on them in the last couple of weeks with great vigor and lots of debate around some of the micro topics that'll be brought to bear, which one of which you mentioned. I think overall the need for that capital expenditure is so large that yes, while there will be some domiciles that decide to sort of push back on the thematic, it's one that by and large will end up winning the day.
I know you don't want to touch single names, so I won't come to you on this, but market timing of Alphabet's just incredible. That C-suite, the way they timed that equity raise was just perfect. Tactically speaking, you might be wondering whether it was sort of opportunistic as well to maybe derail some other people thinking about doing the same thing. I wouldn't suggest such a thing, but I'm sure people might be asking that question.
It's not just the equity raise. Also, the debt issuances, they've all been raised at some of the peaks in markets.
Perfect time.
But this ultimately goes to the anxiety right now in markets. Why would someone IPO? Is it because they need the capital or is it because they see the window open? And how big is that divergence? I think that's an important thing. Is it that the market is just really open or is it just that they actually need the cash?
I say, perfect timing, but they also shape outcomes because they're so large. So when they come to the market, they start moving things around.
First mover advantage is a very real thing. I mean, I will touch the single thematic, which is
Sure.
we have seen more equity raised from investment grade issuers in 2026, and it's the largest investment grade equity capital raising since the financial crisis, and obviously funding into growth as opposed to forced funding in many instances. And so I do suspect that we'll see similar thematics. Thank goodness they're doing it in the U.S. equity capital markets, which are capital formative, and they're pulling on every level available to them. Private capital via pipes, at the market offerings, low cost, sort of go anywhere and raise at any time capital. So thank goodness that they're doing it here in our market. Harder to do in other parts of the globe. The window is open, and we're in the latter part of the cycle. So we have seen a lot of the first round of very high quality issuers come to market. Our private equity clients, who are responsible for nearly half of all IPO issuance year to date, have owned these private companies longer, scaled them more significantly, and are looking out at an equity market that's re-rated probably 10 turns in value since they bought these assets. And so we're still operating from a place where there is a lot of investor enthusiasm, even about what's left in the backlog. And so we shouldn't lose sight of that and what that could mean for an open window for the back half of this year.
Michael, good to see you. Thanks for being here.
Thanks for having me.
Appreciate it. Thank you, buddy. You were fantastic. Michael Ventura there of RBC on this equity market. Anthropic, look, there's lots of demand for Anthropic, but the one I'm thinking of, OpenAI is kind of hanging out there, right? Talk of maybe delaying that IPO. Talk about first mover advantage. There isn't much of an advantage if you're the last of the big movers.
Especially because people do seem to be tiring somewhat. I do think both of them are challenged by what we heard with the moonshot over in Kimi 3, given the fact that ultimately there's a question about whether they will be the beneficiaries or whether it really will be the hyperscalers. And that, I think, is going to hang over whatever IPO gets to the market first.
Futures this morning, just about positive by a little more than 0.1%, close to 0.2% higher on the S&P, with an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. Bloomberg hosting 6 candidates vying to be the next UN Secretary General.
Our responsibility is to make the UN relevant again. I believe moral authority is always needed.
What we need to do is to restore this credibility of the UN as a valid interlocutor.
I would like to see a UN that is back at the table in the scenarios of conflict.
The UN must be more present, especially in the peace and security arena.
The candidates are competing to succeed Antonio Guterres, whose term ends this year. In earnings, American Express raising its revenue forecast for the year after reporting second quarter earnings that topped Wall Street estimates. Customer spending growing 9%, the highest rate in 3 years on a currency-adjusted basis. And Verizon reporting second quarter mobility and broadband sales that beat analyst estimates. The company raising its full-year guidance for some metrics, including adjusted earnings and cash flow. And that is your Bloomberg brief. John.
Bonnie, thank you. Thank you for the update. Up next on the programme, finishing the job in Iraq.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. We want to get it over with, and we want to do it right. We have to do what we came to do.
That conversation up next. Crude this morning just off triple digits, pulling back to about 98 on Brent this morning. We're down by close to 3%. Under surveillance, finishing the job in Iran.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. We want to get it over with, and we want to do it right. We have to do what we came to do, and that's we can't let these people, very violent people, we can't let them have what they want.
So here's the latest this morning. The US striking Iran for a 13th consecutive night. The president telling Axios he is considering a, quote, massive attack to push a peace deal. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, at this point, little public indication that diplomacy is getting back on track as President Trump now threatens wider escalation. He's previously previewed there's a few options on the table, including escalating strikes against Iranian infrastructure, including bridges and power plants, as well as going after what's known as Pickaxe Mountain, a site believed by the U.S. to hold nuclear materials. We'll have to see where it goes from here because we have to keep in mind that the U.S. is now dealing with another new front when it comes to the Houthis in Yemen and threatening shipping in the Red Sea.
Tyler Kendall with the latest down in Washington. Tyler, thank you. The Republican Senator Dave McCormick coming fresh off last week's Pennsylvania Defense and Innovation Summit, securing $10 billion in new investments for his state. The U.S. Senator Dave McCormick joins us now for more. Good morning, sir. It's good to see you.
Good morning.
Let's talk about the nature of this challenge. And the character of the challenge defensively has changed as well. And the Middle East is a fantastic example of that this morning. What do we need to change when we think about the kind of investments that need to be made in this country?
Well, there's three big changes that have happened. One, the world's getting more dangerous. Two, the nature of warfare is changing dramatically with drones, autonomy, AI. And third, we've had apathy within our defense ecosystem. So we need to introduce new players into our defense ecosystem, drone manufacturers and all sorts of other unique capabilities. And we need to change the way we procure defense systems. So it needs to be much faster. It needs to be much more competitive. We need to constantly be innovating. And so the focus of the summit was to bring together the traditional industrial base. We've gone from to 1% of global shipbuilding. So we need to go back to the core industrial base, but introduce all these new technologies into the mix. So the goal of that was to bring those players together, have the president, have his cabinet there, have all the major primes, all the emergent technologies, all the big investors, because you need the capital, and talk about ways to move forward in accelerating our ability to man the battlefield with this next generation of weapons.
Senator, it's an important conversation to have now because we are relying on inventories when it comes to the war in the Middle East. All that has been given in terms of Russia's invasion of Ukraine. Where are we on defense inventories?
Well, I think we're adequate in terms of being able to continue to conduct military operations, but there's no doubt that we need to ramp up our production capacity. Let me just give you an example. In Ukraine, they make 10,000 drones a day. A day. We have nowhere near that manufacturing capacity here at home. So we need to ramp up that manufacturing capacity in shipbuilding, as another example. In Philadelphia Shipyard, we build one ship a year. We need to go to 20, which we're doing over the next 5 years. So we've let ourselves become more dependent on others, and we've let ourselves locked into looking backwards at last year's or 30-year-old platforms, as opposed to embracing this next generation of technology.
When it comes to the next generation technology, when it comes to the Iran war, we even heard from Palantir executives, this is going to be the first war that really was conducted by AI. Are you concerned that China is building a model like Kimi K3 off of our technology?
Yeah, absolutely. I mean, China has a tradition of stealing our intellectual property and using that to their advantage. That's why we need to continue to do all the things necessary to lead in the AI race. I always like to say that I'd rather have our hand than China's hand, but it depends on what we do. So we need to embrace the compute capacity and the energy capacity needed to be in the lead. We need to make sure we don't overly constrain our innovators, because this is really the most important technology race of our lifetimes.
And we are throwing tons of capital at it.
We're throwing tons of capital.
And that's what's different about this moment, I think, for Treasury. And I want to make that pivot. I think it's important. The military costs a lot of money. We know that. And the deficit wasn't a problem because we didn't see the biggest companies on the planet raising the capital to the extent they are now. And you start to see these moves, and you're in a fantastic seat. And I mentioned this earlier on the programme. You're in many ways the perfect seat because you bring to the Senate experience on both the geopolitics, the cost of war, and Wall Street, how you finance it. Are you starting to get concerned about what's happening with the bond market here at these levels? And if not, when?
Well, listen, we are in uncharted territory. I think last time I was here, we talked about this. We've got a couple things going on. We're in the middle of this geopolitical shock with what's happening in the Middle East, and we're also in the biggest capital boom and productivity wave that we've ever seen. So I think we're digesting both things at the same time. And we talked about my friend Kevin Warsh now in this unique position because he has these inflationary pressures coming, but we also have this huge productivity boom coming. And I think he's wisely said we're going to launch these committees. We're going to figure out how we're going to think about the models for the future. And he's also talked in, I think, very convincing ways about the need to guard against inflation. And so I think for the foreseeable future, we've got all these factors, and we need to just keep our powder dry.
Do you think he should hike next week?
I think we should keep our powder dry.
That means hold.
Well, listen, I'm unfortunately not in that position because
Senator Warren, your colleague from Massachusetts, has no problem calling out the Federal Reserve. You're in a position where you can say what you think.
Yeah, listen, I think given all those factors and uncertainty, I would like to see interest rates stay where they are.
Senator, it's good to see you. Appreciate
good to see
your
you.
time.
Thanks for having me, guys.
Thank you. Senator Dave McCormick of Pennsylvania on military, defence and the cost of war and what it means for this bond market too.
Yeah, and at a certain point, how do you compete with all of the fundraising and how do you deal with this, a time that is a really interesting time? I mean, some people would say, this is a very challenging time for the likes of Kevin Warsh, and he's chosen the wise thing of not saying anything that could really fit him down in any way because it's a very difficult time to come up with conclusions.
That Fed meeting a week away. Up next, Meghan Swiber of Bank of America, the Cisco president Jeetu Patel, Neil Dutta of Renmac, Kara Murphy of Kestra Investment Management. The third hour of Bloomberg Surveillance just around the corner.
I'm still very bullish on the overall AI infrastructure.
Second quarter earnings will probably mark the peak.
That bar, again, has become so much more challenging for rewards here.
There are legitimate questions about cash flow.
Aren't we all believing a little bit too much into that U.S. exceptional picture?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equities up by 0.2. This is your bounce from the biggest one-day loss of the month so far. On the S&P, up a quarter. On the Nasdaq, only up a little more than 0.1%, heading towards a second week of losses. In the bond market, holding on to these levels. We'll talk about rate hikes a little bit later in the program with Bank of America. Twos at the moment at 4.32, baking in those hikes comfortably above the policy rate at the Federal Reserve going into next week's meeting. And we had some weight to the yield on 10 and 30s in the last 24 hours, coming down just a basis point this morning. 10s, close to 470.
Yeah, and this really has been the notable feature is just how long these levels have persisted. And happy Friday, John. It is going to be a weekend a lot of people need after the tumult that we've seen over the past number of weeks and months. And frankly, a real question here is, do we start to see cracks in the consumer? And you talked about how the resilience has been the feature of this market, the reason that you could see bond yields at such an elevated pace. Is that strength potentially a bug and not a feature when it comes to the Fed meeting next week?
I love a game of if I told you. You know, if I told you that crude was at 100, that twos would be 50 basis points plus above the policy rate, the Fed, we'd be talking about rate hikes. And we wouldn't be having a discussion about a growth scare and that equities would be 2 to 3% away from all-time highs. If I told you that at the end of February, you think I was nuts, maybe mental. Perhaps you still do. I don't know. But this is where we are.
Yeah, I would also think that you were nuts if you talked about how much debt issuance there was, how much equity issuance there was, how much has just been thrown at this market, and the fact that it still is within all-time highs. That also would be surprising to me. This has been a bulletproof market because of the churn under the surface. Can that continue, or are you starting to see enough of the pillars start to just see a little bit of fractures?
I'm really trying to think back at where we were for Liberation Day when Trump said the bond market's yippee, he's going to reverse course on some of these policies. And I'm thinking, what is the Trump put now? Are they still moving? Are they still moving based off $100 oil, based off higher 10-year yields? I'm not sure.
I'm pleased you keep repeating this because I think it's so important. You bring up the yield curve again, 2s, 10s, and 30s, and we can just look at, say, 10s. The 10-year yield in the last 24 hours, above where it was off the initial energy shock, above where it was Liberation Day week, Liberation month, wherever it was, April last year, when people were freaking out about the breakdown of the bond market and yields pushing higher. I think people were also worried at the time about the breakdown in the economy. That's why things are different a little bit now. So if you're in Treasury or at the White House and you're seeing yields spike higher and people are worried about growth, you've got a major problem. 12 months later, 12 months plus, that's not the backdrop right now. You've got yields going up to 470, let's call it. You've got crude at 100. And I don't see a lineup of people coming on the program worried about growth. In fact, they're so comfortable with the backdrop in the labor market right now. They've got conviction around the Fed that they believe the Fed will focus on inflation and hike interest rates. It makes 2026 so different at these same yield levels, slightly higher than where we were in 2025.
Earlier in 2025, when yields went up, people went into the hyperscalers and big tech because they were the haven when you potentially got that growth scare as a result of higher yields. Now, people are using it as a time to rotate into other names because it indicates the broadening out in the U.S. economy. To Annmarie's question, where's the Trump put? It doesn't seem like there is one right now. It seems like this is a market operating on the AI trade, on oil, and potentially on the borrowing needs of nations across this world.
I know everybody's excited about the weekend. You'll need some rest because next week looks like this. On Wednesday, a Federal Reserve decision and a ton of earnings from big tech start to come through as well, from the likes of Microsoft, from the likes of Meta, and then on Thursday, Apple and Amazon. That is a major week coming up next week for both earnings and monetary policy.
If we get to Friday and markets are responding to earnings the way that they did this past week, Max Kettner, please come back on and let's hear if you're bearish, because ultimately that was the tell for him. If you saw people sell off in the face of good news, that would be the tell that for positioning, things were changing on the margins.
We've got a big week coming up. Coming up this hour, a big hour too. Meghan Swiber at Bank of America with stocks on course for back-to-back weekly losses. Cisco President Jeetu Patel on the race to build AI cyber defenses, and Neil Dutta of Renmag making the case for a rate hike maybe as soon as next week. Look out for that conversation in just a moment. We begin this hour with stocks looking to bounce and bond yields sitting near the highs for the year. Meghan Swiber at Bank of America writing, we hold the yield curve flatter, but see risk to higher rates across the curve. If the Fed delivers a hike, we think the market can very quickly jump to 75 basis points. Meghan joins us now for more. Meghan, good morning. Good to see you.
John.
Let's just start with the setup then. What are you looking for from Kevin Walsh and the team next week?
So, John, what we've been hearing from a lot of the market for the past several weeks is we have a Fed chair that is going to be very reluctant to hike rates. A lot of that coming from this political debate that Walsh has really got this mandate to cut, that he needs to be considering this other side of the mandate on labor. But what are we seeing even in terms of the recent claims data? The labor market is so strong. We see this in a lot of our BofA card data too. Very strong U.S. consumer. And you mentioned this conundrum, right, with oil prices as high as they've been, yet we're not talking about a growth scare. We don't see evidence of that at all in terms of our consumer data. And it's not just upper income we're talking about. It's across the spectrum of a story of a very strong consumer and a Fed, when they think about this distribution of risk between unemployment and inflation. June meeting, every single FOMC participant saw more upside risk to inflation than the unemployment rate.
So the jobs market, language matters. The way you described the jobs market, you said it's strong. There's a difference between saying the labour market's not a problem and the labour market's strong. There are some people on the Fed, I believe, who are focused on inflation and saying, I don't have to focus on the labour market because it's not a problem, it's OK. But saying it's strong, I think, introduces a different risk. Do you think the labour market is sufficiently tight enough right now to be a problem for inflation, to be a source of inflation?
We're not seeing that in any of the official data yet. And really, the final tell for the Fed is going to be upward pressure in wages. We're seeing some of this in our BofA card data, in our BofA deposit data, but we're not necessarily seeing that translate fully through to what the Fed's looking at. But let's just talk about how we think about Fed Taylor rule. What are they looking at? Well, since this time last year, unemployment rate has declined, and the real Fed funds rate has eased over 100 basis points. So a Fed that maybe goes in July, maybe more like September, which is what our base case is. Once they go, the market's very quickly going to extrapolate what this means for the cadence of these hikes. And that's how we still see the market underpricing what this could look like and see this quick jump to 75 basis points becoming more the norm in market pricing.
If the Fed did price in a greater number of rate hikes, would that be a good thing for the long end of the curve?
I think it actually would be, Lisa. And a big part of this, right, is the debate around Fed credibility, Fed independence, and inflation. The kryptonite for the long end of the U.S. rates curve is inflation. When we think about periods of time where multi-asset investors, folks who are buying treasuries to diversify risk versus equities, the period of time that those types of investors really begin to worry about back end of the yield curve is when a central bank cannot control inflation. Look at what we see in terms of the JGB curve right now, in terms of the risks that they've had to contend with because they don't have a central bank that's taking enough steps, at least in terms of what the market's expecting to combat inflation.
Earlier this morning, Nikkei was reporting that the Bank of Japan is probably going to remain on hold next week. Just the counterfactual here. What if the Fed does remain on hold in next week's Fed meeting? Do you expect that, or let's say that there's a dovish surprise where they indicate that maybe they're going to remain on hold and they get some sort of forward guidance? Not likely, but let's say. Does that mean that you expect the long end of the yield curve in the U.S. to sell off further? I mean, would that be a liability for U.S. debt markets?
I would see that as moving longer-term inflation compensation higher. Since Warsh has come out as aggressively on 2% inflation, talking about this 5-year of inflation mess, not just talking about this as a couple months of the problem given the move that we've seen in oil prices. We've actually seen longer-term inflation expectations re-anchor and kind of trade at the lower end of recent ranges. And I would expect that a Warsh that sounds more dovish next week causes these 5-year inflation measures, causes longer-term break-evens to move higher, and we could get the market more concerned about what these longer-term risks could look like for a Fed that is not going to be viewed as credible on inflation.
What's a bigger risk factor for debt markets next week? Is it the Fed or is it the tech earnings and the potential CapEx plans that they have potentially to announce?
It's such a great point, too, Lisa. And when we think about over the next couple of weeks, I'll just add another one, which is quarterly refunding the week after Fed. And that's usually and historically has been a pretty sleepy event for the market. But so much of the focus now, especially given the very strong IG issuance that we're seeing, is what is Treasury going to do? And at the last refunding meeting, we're seeing some of this tension between TBAC, which is Treasury's Borrowing Advisory Committee, in terms of guiding to the fact that deficit risks are only going one way. They've really got to ramp up some of this issuance coming next year, versus a Treasury Department that's talking more about increasing that bill share, which is less duration supply to the market, has less of this impact on longer-term yield levels. So totally agree. The IG story, the issuance that we're seeing in credit has actually more than offset the declines that we're seeing in terms of the amount of coupon supply that Treasury's been able to reduce this year.
I know we went through earnings and the Fed next week, but what if we have a weekend where the president is saying he's considering a massive attack on Iran and the conflict just gets even worse?
Yes, and geopolitical uncertainty continues to creep higher. And we're talking about a Fed, again, a couple months ago, them looking at these inflationary risks and saying everything is skewed to the upside there. I think it just puts more pressure on the Fed to go, especially if we're seeing that pass through to how the market views and perceives these inflation risks.
You've got the calendar up at Bank of America. What's circled right now? September? Where are you thinking?
September, John, is our base case. But the market's not ruling out July, and honestly, neither are we. We really don't have the market trading this level of uncertainty ahead of a meeting. When we look back over periods of time, I was just doing some of this analysis yesterday, actually. There's two periods that stand out as where we see the market pricing, even more uncertainty. And that was back in 2022 when the Fed delivered that surprise 75 basis point hike, and September of 2024 where they delivered the surprise 50 basis point cut. And we did see, some media reports coming out before those decisions to guide the market in a discrete direction, which maybe we don't get this time. He wants a family fight.
Always enjoy catching up with you. Appreciate it. Thank you. Yes. Meghan Swiber there of Bank of America. Circling September. It's new territory. If you've been in the market for the last 20 years, particularly post-GFC, and that's your experience, that's your career, you don't really know a Federal Reserve that doesn't hold your hand. This Federal Reserve typically holds your hand going into a meeting and tells you what they will and won't do ahead of time. We don't know this time around. There is no guidance.
Right now, Fed funds rate is pricing in a 33% chance of a Fed rate hike next week. This is unheard of in terms of just random expectations ahead of it. And as Meghan said, people don't want to trade this. What's your advantage getting ahead of this?
I love how the ECB does it. You know, we were talking yesterday about how the ECB is a three-part act. They'll drop the statement, they'll do the news conference, and then you get the sources later on in the day.
Yes.
It made me laugh because they always go into the news conference now. Their new shtick is we don't do guidance either.
Right.
And then, within the next hour after the news conference is finished, there are sources speaking to either Bloomberg or Reuters telling you what they may or may not do in September. I mean, it's like...
Exclusive Reuters, ECB considering several options to mitigate losses.
Bloomberg, we had the same thing out yesterday. It's fantastic reporting from the team, but it just makes me laugh. You can't sit in the news conference and say it's a new world, we don't provide guidance, and then provide sources on the side that provide guidance.
Well, some people can't help themselves. And frankly, they want to get their voices out there, and they're on a stage to really deliver something, so they want to do so. It doesn't seem like Kevin Warsh really does that yet.
Some central bankers just can't get away from that world. Let's give an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. The US will impose tariffs of between 10% and 12.5% on imports from most major trading partners after finding about 60 economies harmed American workers by failing to prevent forced labor. It's the biggest move yet by the Trump administration to reconstruct the tariffs that were struck down by the Supreme Court. SpaceX is betting big on Starship. Sources telling us here at Bloomberg, Elon Musk's company is turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028 as it plans to transition Falcon 9 for Starship. The company declined to comment. Facebook Marketplace is branching out. The New York Times is reporting Meta is launching Seller, a standalone app for Marketplace users. Marketplace is one of the most popular features on Facebook. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next, the Morning Calls Plus. We'll catch this up with the Cisco president, Jeetu Patel. As an unprecedented hack, what a week it's been for AI. Sends new fears through the cybersecurity industry. That conversation with Jeetu is up next.
Overall, I still think ultimately that tech will be a buying opportunity. Is it right here, right now? I'm not sure about that yet, but ultimately I think money will rotate back into tech. This is the fifth pullback of at least 10% during this bull market. It's just a love-hate relationship that we're seeing. I would still think I'm giving tech longer term the benefit of the doubt.
That was Keith Lerner of Truist giving tech the benefit of the doubt. Not much of a bounce for tech this morning, up by just 0.2 on the Nasdaq, and that's a talking point for this market this morning. Where is the bounce? What happened yesterday with chips? Had a decent run of gains, a bit of a bounce back for the chip players, and then kind of odd that we saw the names like Alphabet, Tesla punished for spending too much, and then the companies that receive all that money not rallying off the back of it much at all.
Yeah, you could come up with a narrative if you wanted to that maybe there are questions just in general how much people are going to be willing to spend into the future given the fact that there is some market pushback. I will say yesterday was just a big risk-off day, and we haven't had a correlated risk-off day like that in a long time where suddenly all the pillars seem to be breaking down at the same time. If that continues, people might start getting nervous that the churn under the surface turns into something a little bit more directional.
You nailed it this morning. What'd you call it? A puke? It's one of those pukes, wasn't it?
It was a puke.
I just hate that word.
I know, but it's just...
Risk puke, bottom puke.
It was,
every time she said it, I was cringing.
I'm not a big fan of that word either. But it was, the classic sort of Bond puke. We're doing Friday still.
Well, I was going to keep doing it.
40 minutes, Grandma. Give it a break.
No, let's hope it's not another day.
That's the equity picture. Let's get to some morning calls. First up, Wells Fargo raising its price tag on Intel, seeing sustainable server CPU momentum. Your second call from Citi, trimming its price target, maintaining its buy rating. On IBM, saying the company's outlook is, quote, better than feared. And your third and final call from UBS, rating its price target on AMD, seeing a potential path forward towards sustainably higher EPS. That stock is up this morning by about 1.2%. They're three of your calls. Let's stick with tech. Cybersecurity concerns mounting after advanced models from OpenAI went rogue, hacking tech from Hugging Face in a first-of-its-kind incident. Cisco taking a head-on approach, unveiling a brand-new AI tool designed to find and address weak points in software. The Cisco President and Chief Product Officer, Jeetu Patel, a good friend of this programme over the years, joins us now for more. Jeetu, good to see you, sir. Great to catch up.
Jonathan, great to see you. How are you?
Let's get into this issue. I'm OK. I'm always nervous. You know I am. And then I see those stories like this week and it makes me even more nervous. I've been asking you this for a while. Can you tell us, do you think these developments will expose vulnerabilities or over time just make these systems more resilient?
I think the reality is that, well, it'll be a little bit of both, because what you'll start to see happen is these agents are getting to be long-running agents that when they're given a task, sometimes they just keep going down that task. So for this thing that happened with OpenAI and Hugging Face, basically what happened is all that the agent was given was a goal. And it figured out a way to get out of the secure enclave and go out and make sure that it actually, stole the model weight someplace else and stole the test. And so what you can start to see happening right now is we have to, one, be prepared that an agent might behave out of the bounds of what you think is normal. And two, when it starts behaving that way, you have to be able to intercept it and be prepared that that behavior could be, pretty bad for you. So it's something that we're just going to have to live in this new world where agents are going to, as agents mature, we will have to figure out a way to intercept them and they're not behaving the way that we deem it to be appropriate.
Jeetu, I remember when IBM came out last week and started talking about the change in focus and the wholesale shift towards cybersecurity earlier this year, as we learned about Mythos and Fable and how that affected their earnings. I'm just wondering, from your perspective more broadly, if you can sort of quantify or characterize just how much interest in cybersecurity has picked up and really concentrated the focus of CEOs around the world?
I think right now, if you think about what's happening in AI, there are two areas that are of material concern for organizations. Number one is cybersecurity. Number two is the cost of tokens. And these are both things that most organizations are concerned about, because if you have an agent start to misbehave, are you prepared as an organization to be able to intercept that and make sure that your organization is safe from the exploits that the agent might be able to go out and create for you? And so it's a very, very important area of the business. It's something that actually prevents some organizations from leaning in all the way with AI. So we have to make sure that cybersecurity and the safety of AI is pretty important and dealt with it with appropriate level of emphasis. And then the second one is the cost of tokens. It's these costs of tokens can accelerate. These agents can, they're running 24/7. And if you don't monitor and observe the consumption of tokens, and when you start to see an agent go rogue, be able to put some boundary conditions around the agent, you could actually start having some very big bills that you hadn't forecasted for. So those are the two areas that most organizations are thinking about right now as they make their deployments within AI much more kind of broadly deployed.
It's a really interesting view on token maxing and why we're seeing a shift to token rationalization. I'm just wondering, Jeetu, if you think that the renewed focus on cybersecurity has taken some budget away from exploring ways to become more efficient, other deployments of artificial intelligence?
I think it's most organizations have always had the balance that they've played where, for example, right now there's more emphasis and more budgets being spent on AI, and there's also a lot of budget being spent on cybersecurity. Of course, at some point in time, there's a finite amount of dollars that are there in IT that come from somewhere. But I think organizations, what they're doing at this point in time, at least, is making sure that they've learned the hard way from the previous kind of episodes like COVID, where if you don't have enough amount of forward investment in tech, then you could actually be put in a world of hurt as a company. So you have to make sure that you're forward investing in some of these areas. So I'm not seeing the reason that people are investing in cybersecurity taking away from certain other areas, such as AI. But I think over time, you have to make sure that AI is starting to go out and produce enough positive return so that you can continue to have the investments being made in infrastructure for sure.
Jeetu, there's another debate about what's going on in terms of China. Do you think Kimi K3 is potentially using U.S. technology? And what do you make of what is going on right now in terms of the race?
Look, I think firstly, China is a formidable competitor to the U.S., but they've actually made a tremendous amount of progress. And this notion of is China using distillation? The answer is yes, but that's not the only thing. They've actually done a fair amount of things that are very, very creative to go out and create a frontier class model and make it available, to the general public as an open rates model. So we should, as the U.S., we need to make sure that we continue to invest not just in closed source frontier class models, which we've been the leader in, but we also need to make sure that open source becomes a larger and larger part of our strategy as you move forward. Like it is in our national interest, and it is in the interest of every individual that U.S. models get used all over the world, whether it be closed source or open source. And by the way, companies like NVIDIA have done a good job with the Nemotron models. I think Mira Murati's company, Thinking Machines, that we're an investor in, has done a good job recently of coming out with almost a trillion parameter model with 40 million active parameters. So I think you will continue to start to see more and more kind of emphasis being placed on open source. But it's something that we have to you have to keep a close eye on.
Don't we need some Jeetu Patel interior design? Don't you want an office like that?
Oh, yeah. He definitely has this sort of zen.
I got a job for him.
Maybe it's...
Seriously.
Is it real? Or is it AI?
Come over sometime, John. It'll be good to have you over here. We'll do it from here.
You're going to have to set up some agents for me or something, I need that help. I need that help. I'm going to be in touch. You know that. Jeetu, it's good to see you, sir.
Are you still skeptical on AI? Have you now gone to the point where you actually believe in the potential?
Skeptical is not where I'm at. I'm constructive. I'm worried about the messaging at the moment and the amount of money being spent. So I'm less concerned about where the technology is taking us and more concerned about where the technology is taking capital markets, if that makes sense. I hope that makes sense.
Yes, good.
Okay.
That's time for another conversation.
We'll have a longer conversation on the phone. Jeetu, thank you. Jeetu Patel there, the Cisco president on the latest.
Yeah.
Turning the tables there.
I know. I like that.
I've got time for that. I've got time for that.
But, I'm a little concerned about, nuclear war and things of that nature.
That doesn't shock me.
But...
That's all. The up and about 60 minutes away. Equities bouncing back by, let's call it a third on the S&P, feeling kind. Up a third of 1% on the S&P 500, up a quarter on the Nasdaq 100. We'll round that up too. Following the biggest one-day loss of the month so far on the S&P 500. Feeling super kind.
Mr. Friday.
We're almost there.
What's going on?
I still won't buy into the Friday stuff. That's nonsense.
You said it more times than you've ever had before.
I know.
This morning.
True.
It's great.
We're keeping a tally together.
Shut it
Shut
down.
what down, John? What are you talking about?
Shut it down. When Ramsey goes into a kitchen, you ever see that program?
Yeah.
It's my favourite show on TV right now.
Sandwich.
I think there's a new season coming up soon.
You moved on from Farmer Dates, Farmer Finds
Wants
a Wife?
No. Nothing can top Ramsey when he walks into a kitchen, and it's always the walk-in fridge. It's always the bloody walk-in fridge. It's like, let's look in the walk-in fridge. Goes in the walk-in fridge, and it is disgraceful. And he'll turn around and say, shut it down. Then he'll walk into the kitchen and, everyone put the knives down. You go into the restaurant, you tell everyone, put the plates down, shut it down.
That's what you're doing with Friday?
Shut it down.
Wait, but shut what down, John? Just say it.
I'm not going there. Bonds right now, yields down a couple of basis points on twos, 433, 10s around 470. We can't shut this down, and that's quite a story in financial markets. Yields are holding on to these levels. That's new. In years gone by, when you start to get to the kind of levels people get nervous about, these sell-offs become self-limiting. People get nervous about risk assets, the backdrop for growth, money goes back into bonds. This is different. People aren't worried about the backdrop for growth. Even with these yields, there is no growth scare. Maybe there is on the margin in the last 24 hours, but not much of one.
One thing that we've gotten accustomed to is thinking of this economy as being less interest rate sensitive than it has been in the past. So even if rates do stay at these levels, people are saying we probably can continue to grow through it, especially given the pillars of AI investment. Also, it's really nice to get this yield, and it looks like a great opportunity when you can't get it anywhere else. When you can get it everywhere else, when it comes to hyperscaler debt or other governments, well, then people are a little bit more choosy.
6-month-old chicken thighs, things like that, like
Oh,
really moldy.
ew.
That's disgusting.
Oh, I thought it meant it wasn't
I'm
organized because I've seen your fridge before and it's like almost color coordinated.
That is not
organized.
equivalent to Friday. I find that offensive.
Shut it down.
Yeah, with 6-month-old chicken thighs.
Such a good show.
And Friday, that's horrible.
Such a good show,
I'm offended.
Bramo. Brent crude around 98, we're down 3% this morning. WTI around 3% lower as well, around 90. Talking about holding these levels, we struggled to hold the highs in the first period of the shock, the first phase of things. Inventory's a big piece of that, China too. Can we hold the highs this time around?
I mean, we're at $97 on Brent, and the president's saying, I'm considering a massive attack. They haven't received enough pain yet, talking about the Iranians. And what we continuously are seeing in the global oil market is the fact that we already know the Strait of Hormuz is grinding to the halt with ships trying to get through. Bab el-Mandeb Strait becoming incredibly harder with the Red Sea. At the same time, we are on the lows when it comes to inventories, and everyone's focused on product. Lisa nailed it, talking about diesel. This is where really the angst is. Diesel, jet fuel, gasoline, etc.
We should send Ramsey to the Fed next week.
2 slices of bread on the ears.
Oh, that's a good show too. What's that, an idiot sandwich or something like that?
What is this? An idiot sandwich.
Brutal stuff.
That's what you watch in your free time.
Brutal. You watch Ramsey when he first went on TV. There was a great programme. He was first launching his restaurant, trying to achieve a Michelin star, something like that. Or a second or a third, I can't remember now. But the attitude starts to come through, and he got that from a guy called Marco Pierre White. Marco Pierre White was a total legend, and Ramsey came through that world, and Marco was a pretty aggressive chef back in the day. We miss those kind of characters, don't we? Yeah, the kind of characters, the charisma that those guys had back in the day, the chefs of the 80s, you know?
I enjoy watching them on TV, not having, too much.
No, I don't want to work with those kind of people, you know.
Totally, but they're good. They're good. They're dramatic.
With those characters in the world. Okay, let's talk about the Fed. The Fed facing growing inflation risk ahead of its rate decision next week, soaring energy prices, sweeping new tariffs on US trading partners, fueling debates over hiking rates maybe as soon as next week. Mike McKee has more. Good morning, Mike.
Good morning, John. It is kind of remarkable. A month ago, we had a very benign CPI report, and everybody was talking about the Fed on hold forever. And now, all of a sudden, this growing chance that Wall Street sees a rate increase from the Fed next week. What's going on? Well, you can find the votes for it if you're looking, because there are enough members of the Open Market Committee who have either said raise rates or will raise rates if inflation doesn't come down. And the case for inflation not coming down is growing at this point. In the minutes from their June 17th meeting, Fed officials said a rate increase might be appropriate if AI demand raises prices because there's not enough supply for AI materials, if the war raises oil or other commodity prices, or if tariffs raise prices. Well, check, check, and check. You got all those things telling you that inflation is going to rise again. What we don't know is what the other half of the voting members of the Fed are thinking at this point. John Williams says we're well positioned for the future right now, but there's still 4 members who haven't really spoken out about this. One would assume Mickey Bowman is not anxious to raise rates, but the other 3 could vote that way, which leaves us the wild cards. Kevin Warsh, we don't know what he's thinking. He doesn't like inflation, but does he think it's an immediate danger and something that needs to be done? People say also it might build his credibility to raise rates next week. And of course, Donald Trump, he controls the war at this point, and he basically has control over oil prices. Investors, though, see 2 rate increases by January, 1 in September, 1 in January, which is completely different than the Bloomberg Economist survey, which is out this morning. They see no hikes, and they see a cut in the second quarter of June 2027, actually the July meeting of 2027. So what's going to happen? Nobody really knows. I haven't got a good idea about what should happen, other than you got me thinking, John, if you sent Gordon Ramsay into the Situation Room where they're all talking about the Iran war and he says, shut it down.
Mike McKee would have a different backdrop for crude, without a doubt. If they listened to Ramsay and he had any authority down in Washington, D.C. Mike, appreciate it, buddy. Thank you. Into next week, we don't know. That's new for Mike. It's new for us. It's different.
Gordon Ramsay would be a family fight that we'd all watch.
Without a doubt. That's a different kind of family fight.
That'd be a different kind of family fight.
I'm not sure that's the language that will be used next week at the Fed, given the kind of characters on the Federal Reserve. But, maybe I'm wrong.
Maybe they'll just...
Can you imagine Beth Hammack dropping F-bombs in that meeting next week? I can't.
Well, who knows? I mean, maybe that's what happens behind the scenes,
I'm not sure that's how the Cleveland Fed president runs business. But
just being thrown.
Maybe we'll see. There might be sources afterwards that reveal what happened in that room.
You can call in.
Neil Dutta of Renmac, not seeing a reason to wait to hike rates. He writes the following: if you have one good month of inflation data, but you know the next 2 months will be bad, you might as well just do it now. Neil joins us now for more. Neil, provocative piece this week. Appreciate your time and thanks for coming on. Walk us through the setup for next week and why you think tactically this might be the right window to hike rates.
Well, I think following with what Mike said, the sort of checking of the boxes, I mean, I almost feel like, guys, it's sort of hiding there in plain sight in the minutes, right? So you kind of have the AI demand piece. We see that hyperscaler CapEx continues to moonshot. You have the oil piece. And while it's encouraging that oil is down today, I mean, it does feel like the conflict is ongoing, and so I think it's possible that that's fleeting. But we do know that no matter what, gas prices probably go up into August. Lastly, tariffs. The president is doing what the president does with tariffs. So it's kind of, you just go down the list. Now, if you're Kevin Warsh, I think it's important to go hike when you can and maintain some modicum of control over the committee than to hike when you must. I mean, can you imagine a situation where if he wanted to, he could probably get the committee to get on board for a hold in July. By September, he may not be so fortunate. So if you're him, do you really want to have to deal with that? That would make him look, I think, like a much weaker Fed chair. So I think tactically, just give it to the Hawks now. And if the data kind of improve, the war ends, oil falls, you kind of see a renewed disinflation from the housing market maybe, then you can go tell them to pound sand. But, I think you kind of have to fight one thing at a time. And I think the risk reward is, go now as opposed to having to go a lot more later.
Neil, we've known each other a long time. You know how much I enjoy your research. And one thing I think that you're fantastic at, even though you have very strong feelings about a moment, is separating what you think a Fed should do from what you think the Fed will do. I'd love to ask, though, how wide is the spread right now between what you think they will do and what you think they should do? How much daylight is there between the two?
I think the Fed should, to me, I'm more on the dovish side of the consensus. And I think that's because I see a relatively uneven economy that's being sort of held up by one area. People talk about the broadening out in the capital markets, right, John? But do you really see a broadening out in the economy? You don't, actually. If you look at non-AI related structures investment, it continues to remain weak. If you look at residential investment, it's still sluggish. The high frequency data that we have, your own Bloomberg second measure for consumer spending, that's actually quite weak to kick off Q3. So you don't really see that broadening out in economic activity. You see a very uneven economy. And so I think the risk, of course, with aiming policy at one specific area could be problematic because monetary policy is a blunt tool. So if all you're really trying to do, and by their own admission, they'd be raising rates to cool off AI demand, that can exacerbate the stresses in other areas of the economy, like credit sensitive spending, housing as an example. So that to me is why I'm somewhat cautious on them hiking. So it would put me more in a defensive mood if I'm an investor. But as you mentioned, my use case as a analyst is really what do I think the Fed's reaction function is, and I think they're all kind of tiptoeing towards a hike. There's not really anyone in there that's making the case that I just made. And when you think about just tallying up the votes, that to me is important, but it's also important to kind of think about it in terms of conviction, right? Like folks like Beth Hammack and Lori Logan, they have a very high level of conviction. Folks like Philip Jefferson, Lisa Cook, maybe less so. They I think are like sort of they're price takers, not so much Logan and Hammack are price makers. And so if they can kind of corral the, sort of pull along the rest of the committee, I think it's possible for them to do so. And that's kind of why I said, strategically, if you see this kind of debate unfolding in the committee, if you're Kevin Warsh, you can kind of see the tea leaves. I mean, even someone like Williams, who Mike McKee said was sort of, signaling a hold, he's not signaling a hold for long, right? I mean, he's basically going to get on board for September. I mean, a bet on no cuts for this year at this point is really a bet that you get continued weakness in inflation like you saw in June. Possible, I wouldn't bet my life on it. And there's a lot of reasons to expect that some of the improvement we saw last month unwinds.
Neil, I am wondering, a lot of people are saying, what will actually a rate hike accomplish? And you're talking about that, given the fact that there still is a very bifurcated economy. That said, some people like Meghan Swiber of Bank of America just earlier this hour was talking about how it could cap the long end of the yield curve. It could potentially dampen longer-term inflation expectations enough to create a bit more of a ceiling on some of those longer-term yields. Do you agree?
I mean, that's part of what, I mean, this is sort of the same argument that was made after Kevin Warsh sort of pledged allegiance to the flag of price stability back in June. It's just another version of that argument. Yeah, I mean, it would also mean that the Fed is trying to cool off growth, and that's why the long end would be coming down also. Inflation expectations, in my mind, look stable as it is. I mean, but that's, again, part of that is a function of reals continuing to go up because they're committed to price stability.
I guess I'd flip this on its head and say if the Fed does not hike rates next week, does that make you more bullish on going into an equity market that's re-rated on the margins over the past couple of weeks?
I think based on where clients are right now, where the markets are, I could see a scenario where if the Fed doesn't hike and people read that to mean that they're not hiking for the rest of the year, you could see the back end sort of keep pushing higher. Yeah, I mean, I think that there's something to that.
Neil, I know that we always talk about what's interesting on Fed decision days, how the market reacts to things. How do you think the president would react if we get a hike?
I think, again, that goes to Annmarie, the reason why Warsh should do it. He's got the, I mean, it's like, it would be like leaving your honeymoon early, right?
So not good.
Yeah, so I don't think if you're, I mean, what I've found very interesting is how deferential the president has been, right? I mean, I could see a scenario where Warsh hikes, and because Trump has a much bigger fish to fry at the moment, he kind of gives him a pass. By September, October, when you're much closer to the midterms, maybe he won't feel as forgiving. So again, that's another reason for him to get it out of the way now.
Not advisable. Neil, is that something you considered at the time? Is there something you want to share? I'm not sure where that came from. Leaving the honeymoon early?
That'd be terrible.
Oh, no,
Brutal.
It's a metaphor. It's a metaphor.
Depends where you are.
Good to know. Yeah. Thanks, Neil. Appreciate it. Neil Dutta of Renmac on the latest. Left the hotel early on the honeymoon.
You did?
I did, yeah.
With or without the missus?
Of course, she's still with me, Bram. I'm not sure that'd be the case if that had happened.
You're like, I'm out.
Rejected the hotel, yeah.
Really?
Yeah.
Where'd you go? Camp out on the beach?
To a different hotel.
Romantic evening?
To a different hotel.
Yeah.
I know where you went. You went from Capri to Ischia.
Let's not talk about where we went or what we did, but we did ditch the hotel. All right, let's give you an update on news elsewhere this morning. Might be close to the truth with your Bloomberg brief, or maybe not. Let's get Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. Meta is facing higher borrowing costs for its latest data center in Texas. The Financial Times reporting investors are demanding a roughly 40 basis point premium over Meta's previous Hyperion data center. U.S. regulators are developing new requirements to make sure people can safely exit their vehicles. The move coming after at least 15 deaths were related to passengers who couldn't open the door of a Tesla that had crashed or caught fire. The Los Angeles Dodgers are visiting the White House to celebrate back-to-back World Series wins. Many of the team's fans are angry over President Donald Trump's immigration raids in their home city. Stars Mookie Betts and Enrique Hernandez notably skipped the Rose Garden ceremony. And that is your Bloomberg brief, John.
Bonnie, thank you. There was construction on the roof.
Okay, here we go.
Just got to clear it up for people. There was construction on the roof.
I thought it was the towels.
It was a joint decision.
Oh, that's good.
Of course.
Good.
Mrs. Ferro leads everything. I'm not sure I even led that decision. I just followed.
Oh, you're going to throw her under the bus this morning.
Just letting you know who's in charge at home, all right? It's not me. Up next on the programme is set you up for the day and the week ahead. Plus, we'll catch up with Cara Murphy of Kestra Investment Management, live from New York City. You're watching Bloomberg TV.
There's this very highly concentrated group of systemically important publicly traded names. We're at the part of the programming where there's a quality curve being established even amongst those systemically important names. It's a reallocation of capital into other parts of the equity market. It's not a withdrawal of capital. There's a little bit of fatigue, a little bit of digestion.
That was Michael Ventura of RBC on financial markets, the equity market, the indigestion we've seen, some of the jitters, the fragile moves we've seen in both bonds and energy and then equities for a brief moment in the last 24 hours. Equity futures okay this morning, bouncing back just by 0.1%. Check out next week, though. Next week's a monster of a week. It's a big 24, 48 hours and it starts on Wednesday. So take a long weekend. Fed rate decision on Wednesday. You're going to take a long weekend?
Maybe now.
If you want. Then later on in the day, you'll hear from Microsoft and Meta. Then on to Thursday, you'll hear from Apple and Amazon. That is trillions upon trillions of market cap. And Lisa, you asked a really interesting question earlier on. What's more important to the bond market, the Fed or the earnings from the big tech players that are issuing a lot of debt?
On one hand, you've got the Fed that has to give some sort of prognostication about inflation and where their policy fits in. And then you have the expectation for more than $1 trillion of capex from those companies, brought up from $750 billion expected earlier this year. That is supply that is going to dilute a market that already is showing a bit of queasiness.
1 week to go for those big tech earnings and a big Fed meeting. July is live, apparently, maybe on the margin. Here's the take from Cara Murphy of Kestra Investment Management. She writes the following: AI retains the upper hand, but not as strongly as it did just a few weeks ago. What's less watched are mid and small cap names. Cara joins us now for more. Cara, good morning. Good to see you.
Good morning.
No big bounce in tech this morning. What was your reaction to the sell-off in the last 24 hours?
I think these are hints that the market is giving us that they're not going to give a free pass to these names forever. You know, we can all agree that AI is going to be a revolution. It's going to change so many things in the world, but that doesn't mean that these companies can continue to spend with impunity, you know, damaging free cash flow without the true earnings piece. Now, that doesn't mean that it's all over for them, but it does mean that the market is going to be discerning, and we have to be mindful of that.
Do you think it raises the bar just a little bit more for a few of those names that I mentioned next week?
For sure. I mean, I think the CEOs at these companies should be more cautious. They need to listen to what the market is telling them. The market is saying you can't just keep spending money like this.
Well, is it part of the issue, not just the money spent, but also the lack of visibility as to when there isn't going to be an acceleration in terms of the increases that we're seeing every quarter?
For sure. Like last year, it was a little bit different, right? We were a bit earlier in the cycle. The numbers weren't quite as big. This year, we move forward. We know a little bit more about how people are using AI. We also know it's going to be a little bit before we start seeing returns on it. So the market is saying maybe we need to slow this pace a little bit.
Right now, what do you find as an attractive sort of hedge to what we're seeing, which is just the everything risk being thrown at markets depending on the day?
Well, I think the answer to that is actually a lot simpler than many people think. You know, you mentioned the quote about small and mid cap earnings. The market has been so concentrated in a handful of mega cap names. That means that a wide swath of the market has been largely overlooked by investors. Mid and small cap, I think, are just obvious areas. Now, we haven't seen up until recently the resurgence in earnings. So that's really going to be key in the second half of the year. Can these smaller companies actually deliver the goods and grow earnings? We think that they can. And I think that gives the market an ability to pivot to somewhere else.
RBC's Michael Ventura was on earlier, and he said the market just has new cares. They've always been there. They're just caring differently about different things. Do you feel that now, what's going on with the conflict in Iran and potentially higher bond yields?
Yes, I think there is something to that. You know, I was thinking about this morning. If we had the earnings that we had this week, but 3 quarters ago, I think the market reaction would have been very different. Now, Iran, it's a little hard to get around triple-digit oil, right? So that is very real. That is going to really start to hit consumers' pocketbooks, company P&Ls, and so those are very real concerns. I don't know. It's going to be hard for the market to look through that unless we actually have a peace deal and oil prices recede. But I think on the AI side, for sure.
We're learning something about price and positioning every time we get these earnings.
Absolutely.
Intel's a good example of that, speaking to exactly what you just described. Intel out with blowout numbers. And if this was 3-6 months ago, we wouldn't see a move of 4% of the pre-market. You'd see something like a multiple of that, Bramo.
Yeah, but 6 months ago, it was also lower by about half.
Lower.
So, I mean, this is, we're talking about a very different
lower.
valuation. Yeah. I just wonder how much you can get that broadening out if you do have yields continuing to get higher. I mean, do you still see opportunities? I mean, that's ultimately one question that people keep asking.
We've had a 170% rally.
Exactly.
Year to date, which is
that's just
monster.
Yes.
Keep tracking that name, though. It's now only up by 2%.
What's your call? By the end of the day?
I don't make
down?
calls on markets, Bramo, you know that. But I take some signal that if you have a blowout earnings report and you're only up 2%, tells you something about price and positioning.
Yeah, it's the idea that the bar is so high that we can't even see it. And ultimately, even if you blow things out, people still are going to say, I don't know how much upside there's. $1
trillion question, Cara. What does that mean for where you want to be long? Where can you get more bang for your buck right now?
And this is where we're actually bullish on the market overall. You know, I'm cautious on kind of like the future of the mega cap tech names in the near term, but I think there's so much opportunity elsewhere in the market. Overall, the U.S. economy is in really good shape. You know, we're talking a lot about the Fed and, you know, maybe they hike a little bit, but we don't have a massive inflation scare yet. Labor market's fairly strong. You know, consumers are still spending. So I think we still have a really good economic backdrop, and going long U.S. equities just outside of the mega cap tech, I think is a great place to be.
We are still 2 to 3% away from all-time highs on the S&P 500. Cara, thanks for wrapping up the week with us. We appreciate it.
Thank you.
We're looking ahead to a big week next week. That was Cara Murphy of Kestra Investment Management. What a week we've got coming up next week.
To me, the idea that we get both the Fed discussion and tech earnings is going to be a massive kind of determinator for this market. This week, we saw clearly the reaction in markets. We're setting the signal. Any bar that we set is not high enough for you to clear because we have already priced in so much. Next week, if you have that move continue, what does that mean for the rest of this year? And ultimately, Max Kettner, come on and let us know. Have you turned full bull? Full bear.
Before next week, though, also, how do we get through this weekend with the president saying that he's all set? He just has to decide if he wants to make this massive move, like he's considering a massive attack.
Some nervousness going into the weekend. We've had the energy shock. We've had the bond market jitters. We have not seen a growth scare yet. Coming up on Monday, we'll catch up with Seema Shah of Principal Asset Management, Frank Lee of HSBC, Elisa Shallard of Morgan Stanley, and a whole lot more. From New York City this morning, good morning. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.